All right. So last week, by this time, we look at can you guys hear me? Isaac, can you hear me? Lizzie, can you hear me?
Yes, please, I can hear you.
Okay. So last week we look at inventory management, or we started a topic called working capital management, where we look at how we manage all the items in the working capital. Where we look at all the items in the working capital management, which is the inventory, the payables, the receivables, and cash. So last week we looked at inventory management. Today we are going to continue and finish all. Last sitting was receivables management, so we won't spend much time on receivables management. Payables management too, we don't have much under that one. We just have two examples and we look at what we call the cash management. The cash management, we are going to look at theories propounded by Miller Orr and the rest. So we have looked at inventory management, which is likely to come, and cash management is also likely to come. Payables management, that is for it to come, it then to be theory because we don't have much calculation under the payables management. And if you also come to cash management, they are fond of examining the Miller Orr, where you are going to calculate the spread, the return point, and those kind of things. So we are going to look at those things this morning, and we say bye-bye to working capital management too. All right. So if you are talking about payables management, we are just trying to see if we can get a good credit terms. Like, how are we going to pay our suppliers? If we can be able to have enough credit terms, good credit terms, that they will give us enough time to pay them. Also, to have a good relationship with them. We don't want a situation where the supplier will be saying that because we don't pay on time, they won't supply goods to us again. We just want to manage our payables so that at the end of the day, they will still be in business with us. That's what we talk about, the payables management. But what happens when the company keeps defaulting the terms attached to the payables, like the credit terms? Or what happens when the company tries to delay payment to creditors? They have given you 60 days that you should pay within 60 days, but you are paying after 60 days, which is 70 days or something. What will happen? Suppliers may not be willing to do business with you again, or they may try to avoid doing business with you by increasing the price of the goods in the future. So if I don't want to do business with you, what I'll do is that I'll just increase the price of my commodity, and you won't be able to afford it. That is what most of the landlords, they do. If they want to eliminate you, they want to sack you, they'll increase their rents and you won't be able to afford it, and that is the end. So if you talk about payables management, basically we are talking about having a good relationship or asking our creditors or suppliers to give us maybe enough credit terms so that we can be able to pay them. But if you keep delaying payments, like you keep defaulting the payment terms, what will happen? Suppliers may not be willing to do business with you again. They may increase price in their attempt not to do business with you, and the company will also be damaging its image because you are not paying, and that is not a good sign. That is not a good sign. But under this one, you see, basically payables, we don't pay interest on payables. Payables is a form of business finance, or it's a source of business finance which comes with no interest. It comes with no interest unless you are not able to pay within the credit terms given to you. That is why you pay interest on overdue debts. But all things being equal, there is no interest payable on suppliers amount or payables. So payables comes with no interest. But sometimes what will happen is that the supplier may try to give you discounts, so that to encourage you to pay on time. So if they are trying to give you discounts, Can you see my Excel sheet?
Yeah, let me see.
Okay. So they are trying to give you discount. They are trying to tell you that you should pay early. So assuming you are paying within 60 days. Assuming you are paying within 60 days. Assuming you are paying within 60 days. And now they are telling you that you are paying within 60 days. Now they are paying you that you should pay within 30 days and we give you a discount. For you to decide whether to continue paying 60 days or to start now paying within 30 days, taking the discount, you have to look at the benefits that you are going to get from paying within 30 days and the benefit that you are also getting from paying within 60 days. You know that some payables doesn't come with interest. Payable doesn't come with interest. So if you are paying 50,000 within 60 days and assuming the bank interest rates, bank overdraft interest rate, assuming the bank overdraft interest rate is 50,000, it means that if you should have gone for bank overdraft, 50,000 to finance your working capital items, you should be paying interest of what? 8% on that particular amount. If you should have gone for bank overdraft to finance the inventory and other items, you'll be paying 8% on the 50,000 within the 60 days. So if this should be bank overdraft, how much should I be paying on it as interest? Calculate that for me. 8% on 50,000. How much are you getting? Oh, we don't have calculator there. As if do you have calculator there? As you can hear me?
Hello.
Yeah, do you have
I
calculator
can
there?
hear you, but
Yeah.
I'm in a car, so I'm not really here. No, that's
Okay.
why.
So if you calculate
Mhm.
8% on
Right.
this will give us 4,000. It means that if we decide to finance our working capital items through payables, we'll be enjoying interest benefit of 4,000. This is because we should have gone for bank overdraft. We pay interest of 4,000, but now we are not going for bank overdraft. It means that we are saving interest cost of 4,000. This is the benefit that we are currently enjoying. This is the benefit that we are currently enjoying. But if the suppliers are not telling you that you pay 30,000 within 30 days, and they will give you a discount of 1,500. It means that if you are now paying within 30 days, the benefit that you will be enjoying will be 8% on 30,000. If you should have gone for 30,000 as a bank overdraft, you pay interest of 8% on it. So the benefit that you'll be enjoying under this now is 0.08 times 30,000. And that will give us 2,400. So if they are giving you a discount of 1,005, it means that the total benefit that you'll be enjoying will be the 1,005 plus the 2,400, which is the interest savings. Okay, what is the total amount now? The total amount will be 3,900. This is lower than if you should pay within 60 days. So what you do is that you will not take the discounts. So if you want to take the discount, you have to ask yourself, if I should go for this amount of money that I'm paying within 60 days using bank overdraft, what will be the interest that I will pay on it? Since I'm using payable, it means that I won't pay that interest. So you are saving that portion of the interest that you should have paid on the 50,000 if it should be a bank overdraft. Now, what are the terms that the suppliers are giving to me? They say I should pay within 30 days. If they say I should pay within 30 days now, it means that the benefit that I'm going to enjoy right now will be on the amount that I will pay within the 30 days. Then this is the benefit that I'm enjoying if I decide to pay within 30 days. Okay, together with this benefit, this is the interest that I'll be saving if I should go for this particular money using bank overdraft. This is the interest that I'll be saving. or I'll be paying. But since I'm using payables, it means that I'm enjoying this benefit of 2,400. So what is the discount now given to me? You add the discount to the new benefit that will give you the total benefit. Then you compare with the amount that you are saving first using the normal terms, which is the 4,000. If you look at it, you can see that you are losing if you should pay within 30 days because the benefit that you are getting is 3,900 compared to 4,000. Then you will not accept the discount. But mostly what we do is that we try to calculate the cost of you not taking the discount. So the cost of you not taking the discount, if you calculate the cost of you not taking the discount and it's 10%, it means that you are going to lose because the current benefit that you are enjoying is 8% and the cost of you not taking the discount now is 10%. It means that if you are going to pay within the 60 days, you are going to lose by 2%. It means that the discount, taking the discount will give you a higher benefit than you should pay within the normal days. So what we do is that we try to calculate the cost of you not taking the discount or the cost of you ignoring the discount. How do we do this? This is calculated as 100 over 100 minus t or exponent 365 over t or minus 1. What is the d? The d is the discount rate. The d is the discount rate. The t is the number of periods that you are not going to pay, or the number of periods that you'll be foregoing, or the number of periods that you'll be foregoing, which is if you are paying within 60 days normal, and now they are saying that pay within 30 days, the number of days that you forgone is the 30 days, which is the difference between the 60 and then the 30. So that is the t. That is the t. So let's pick a question and we look at how we calculate the cost of you ignoring the discounts. Okay, let's look at question 4. Question 4. Question 4, they say Swapco is due to receive goods costing 2,500. The terms of the trade states that payment must be received within 3 months. However, a discount of 1.5 will be given for payment within 1 month. So you can see that the normal terms is 3 months, but now they are giving them a discount to pay within 1 month. To pay within 1 month. So what I'm going to do right now is that the question is asking us to calculate. Austin, how are you?
Yes, I'm fine by God's grace.
Okay, so did you get a beginning of what I said about the trade payables, Joycelyn and Austin?
Yes, yes.
Okay, Joycelyn, do you also get a beginning? Okay, so right now, what we do is that if you want to calculate the cost of you ignoring the discounts, the cost is calculated as 100 over 100 minus t, and the t, 100 minus d rather, 100 minus d, and the d is the discount rate given to you in the question. They'll give you the discount rates in the question, and all of these exponents, 365 divided by t, then you subtract the answer from 1. So that is how we calculate the cost of you ignoring the discounts. So let's look at this question. What is our discount rate there? What is our discount rate in the question? Question 4.
1.5.
So we have 100 divided by 100 minus what? 1.5, which is the D is the discount rate. All of this exponent 365. That's 365. The T is the difference between the normal terms and then the new terms now. Under normal circumstance, how many months do you supposed to pay? Okay, this one
3
we are doing it,
months.
we are doing it in months, so this will be 12. So if you are doing it in days, then it will be 365. Okay, sorry. So if you are doing
Yeah.
it in months, then the exponent will change to 12. But if you are doing it in days, then it will be 365. All right. But if you are doing it in weeks, then that will be 52. The exponent will be 52.
This will be 365.
All right. Let's come to this place. The normal terms is 3 months, isn't it? Now they are giving you a discount to pay within what? How many months? Within how many months?
1
That is
month.
to pay with. So what will be the period that you are not going to enjoy? What is that period that you are going to forgo? What is the period that you are going to forgo with between the normal and then the new terms now? How many months? How many months that you are not going to enjoy? If you are paying within 3 months, now they say we should pay within 1 month. How many months that you are not going to enjoy the benefit? Payables doesn't come with interest. So if you are paying within 1 month, it means that you are not going to enjoy 2 months interest. 2 months interest, because payable doesn't come with interest.
2
So if it
months.
is taking you much longer to pay, it means that you are going to enjoy more benefit if you should use other sources of finance for your working capital items. But if they are now asking you to use 1 month, it means that the benefit that you are going to enjoy, because the payable doesn't come with discount, the benefit that you are going to enjoy right now is only 1 month. So what is the month that you are not going to enjoy the benefit for? That is the T, and that is the 2. So it's always a difference between the normal terms and the new terms now, which is 3 minus 1, which is the 2 months. So the T over here will be 2. And all of this answer minus 1. Let's take our calculator, then we see what we are going to get. What are you getting? So that will give you 100 divided by 90. 100 divided by 98.5, or exponent 6 minus 1. Any answer that you get, you multiply it by 100. I'm getting 9.5. Am I correct? Can someone confirm that thing for me? I'm getting 9.5. Jocelyn, can you confirm that for me? Can someone confirm that for me? Jocelyn, can you confirm that? Or we are all not having calculator? Austin, can you confirm the?
So I just joined you.
You just joined.
Mm,
Okay, but press this on your calculator and see whether you give me the answer.
okay.
Yes, sir. I
Nine
had
po-
90.
9.5, isn't it?
I had 9.449, so 9.5.
Okay, so that is how if the payables, there's no much about payables. So the only thing that you can enjoy is the discount given to you. So the first thing is you compute the cost of you ignoring the discounts and the new rate that you are enjoying, the bank overdraft rate. Then if the cost of you ignoring the discount, the rate is higher than the bank overdraft rate, then you accept the discounts. Because if you don't accept the discounts, it means that you are going to pay more. The cost of you ignoring the discount, if it is higher, it means that the discount is giving you a better option than you should keep the discount and pay within the 3 months. Let's look at question 1, then the proposal. Who is going to read the question 1 for us? Then let's solve this question. Then we say bye-bye to payables. Then we come to receivables management, cash management. We are done. All right. So Austin, help us with the question one. Tutorial question one.
Question one.
Yeah.
KC Co is a small owner-managed manufacturing company which manufactures one product. Each unit of their product requires two main input materials, F2 and H7. These materials are purchased from KC Co's two main suppliers. KC Co is currently facing cash flow difficulties. It has gradually extended its overdraft over the past 3 years to its current level of 1 million Ghana cedis. The company also has a loan from the bank for 1.5 million Ghana cedis, which is due for repayment in 2 years' time. The loan is secured on the business premises at a rate of 15%. KC Coast Bank has suffered recently as a result of the banking crisis and has now tightened its lending policies. It has therefore asked KC Co to reduce the level of its overdraft by half within the next year. The finance director, that's FD, is understandably concerned and considers that better management of working capital could release some much needed cash. Two proposals are being considered. KC Co currently purchase all its F2 from supplier A and obtains a 1.5 discount for settling invoice within 10 days. Standard payment terms are 45 days. The FD is proposing that KC Co revert to the standard payment terms with supplier A. Total purchases from supplier A in a year are 6 million Ghana cedis.
Okay, read the first one is inventory. The second one is inventory. Forget about inventory. We have that inventory already.
Okay.
Okay,
Okay.
required.
So I think we did this question last. So A, calculate the net cost or savings for KC Co of implementing proposal one, and recommend if KC Co should go ahead with the proposal.
Okay, so the proposal one is what they are saying that what is the normal, how are they paying? What is the normal payment period? How do they pay normally? They pay within 10 days and enjoy a discount of 1.5%, isn't it?
Yes.
Okay. But right now they are telling them that they should go by the standard payment terms, which is 45 days, isn't it?
45 days.
Okay. So currently, what are the benefits that they are enjoying currently under their first proposal? They're enjoying discount of 1.5 what?
That's discount of 1.5.
Okay. They're enjoying discount
of 1.5% for settling.
Okay. So they are currently enjoying discount of. So we look at the benefit under the current policy. Benefit under the current policy. Benefit under the current policy. So the first one is the discounts. How much is the discount that they're enjoying? It's 1.5%, isn't it? Which is 0.015% times what? What figure are we going to use for the discounts? What figure will be used for the discounts? What figure will be used for the discounts? Yeah?
The figure,
The what?
the total purchase from supplier A in a year are 6 million.
Okay, so what figure will be used for the discounts?
6 million.
Yes, discount is given on total purchases. So they are enjoying the 0.0, or they are enjoying the 1.5% on the total purchases, which is 6 million. So if you do that, how much are you getting? How much are you getting?
90,000 Ghana cedis.
I'm getting 0.09 million, isn't it? All right.
Yeah.
So I'm saying that payable doesn't come with what? Interest. Payable doesn't
Interest.
come with what? Interest. We don't pay interest on payables. So assuming the money that we are paying within 10 days, if we should go to the bank and take that money to finance our items, how much will be the interest that we pay on it? Assuming the money that we are paying within 10 days, if we should go to the bank and go and take bank loan to finance the working capital items rather than using payables, how much interest are we going to pay? What will be the rate of the interest that we pay on that particular amount?
15%.
15%, isn't it?
15%.
All right. But since we are
Yeah.
not using payables, it means that that 15% that we are going to pay, if it should be bank overdraft, we are saving it, isn't it?
Yes.
Okay. So if that interest you should have given to the bank, you are not paying it, it's a form of benefit for you. So you ask yourself, what is the interest that I'll be paying on the amount that I'm paying within 10 days? What will be the interest if I should be taking this money from the bank? So we calculate the amount, the payables amount that we are paying within 10 days. How do we calculate payable settlement period? How do we calculate it? How do we calculate payable settlement period? It is the payables over total purchases times 365 days, isn't it? Is that how we do it?
Yes, please.
So this will be 10 days is equal to the payables figure. Do we know the payables figure? No. Do we know the total purchases? Yes, 6 million. All of this multiplied by 365. Make X the subject. Let's see something. Okay, let me just move on. I'll have 10 days, which is the number of days given to us. 10 multiplied by 6 million, or divided by 365. Am I correct? If you are making X the subject, this is how I'm going to have 10 multiplied by 6M, 6 million, or divided by 365. Am I correct?
Yes.
All right. So for you,
Yes,
whenever
please.
you are giving the payables days, for you to calculate the payables amount, is calculated as the number of days over 365 times the total purchases given to you. So let's come here. If we should go and take that particular money that we are paying within 10 days within the bank, what will be the amount? Let's find the amount first. So it will be 10 over 365 times the total purchases. What is the total purchases? 6 million. So how much are we paying within the 10 days? How much are we paying? How much are we paying within the 10 days? I'm getting 0.164. Am I correct?
Yeah, 0.164.
Okay.
38.
So assuming we are not financing this, we are not financing our items, our working capital items through payables, but we go to the bank and take this money. What will be the interest that we pay on this particular amount of money?
15% on this. So
Okay, and that will give us how much? I'm getting 0.246 million. Am I correct? 0.0246. Confirm.
0.0246.
Okay, so it means that if we should go and take these payables, this money that we are paying within the 10 days, if we should go to the bank and take it and pay within 10 days, this is the interest that we are going to pay on it. But since we are using payables, it means that we are not going to pay this interest, and this becomes a benefit for us paying within the 10 days. So this is also one of the benefits within the 10 days. So you look at the finance interest, you can name it finance interest savings or finance cost savings, which will always be calculated as you take your number of days that you are paying, which is 10 over 365, or multiply by the 6 million to get the amount. Then you multiply it by the bank interest rate, and that will give us the 0 points. That will give us the 0.0246. So what is the total interest that we are enjoying? What is the total benefit under the terms now? Under the first term, what will be the total benefit? It will be this plus this. This is the total benefit that we are currently enjoying. This is the total benefit that we are currently enjoying. But right now, what are they saying? They say we should pay within what? 45 days. So let's look at the benefit under the new policy. Benefit under the new policy. Benefit under the new policy. Benefit under the new policy now is we determine how much are we paying within the 45 days. We have to determine that. How much are we paying within the 45 days? That will give us 45 over 365 times the total purchases. That is the amount. Assuming we are going to the bank to take this money to finance our working capital items, what will be the interest that we pay on it? So if you calculate the interest, it means that if you are using payables, you are saving this, and that is a benefit. So we look at the finance cost, finance interest savings, anyhow you want to name it, which will be calculated as the standard one. The new policy is now 45 days. So 45 over 365 times the total purchases, which is 6 million. This is the amount that you are paying. Then you now multiply it by the bank interest rate, 0.15. What is the total amount? I'm getting 0.0
0.1109.
Okay, but this one is 4 decimal places, isn't it?
Yeah.
Okay, let's just make this one maybe 3 decimal places so that it will be 0 points. Okay, let's make it 0.1115.
Five.
Okay, then let's count to this. This one is to also be 0.11,
111.
isn't it? All right.
Yeah.
So
Yes, please.
the first benefit that we are enjoying was 0.115 million. And this is 0.111 million. What is the question saying? The question is saying that calculate the net cost or saving for KCCO of implementing proposal 1. I recommend if KCCO should go ahead with the proposal. So if you are now going with the 45 days, what will be the amount that you'll be losing? If you are going by the 45 days, are you going to be gaining or you'll be losing? Are you going to be losing, or if you are going by the new policy now, which is 45 days, the benefit that you'll be enjoying is 0.11 million. And the old policy, which is the paying within 10 days and taking a discount of 1.5, is 0.115. What is the net cost or savings if you are going by the new policy? If you are going by the new policy, it means that you will be losing by 0.004 million. The benefit is going to reduce to 0.115 million. And this is a cost, not savings. This is a cost, not savings. It will only be savings when the benefit under the new policy is now higher than the current policy or the old policy of paying within 10 days and taking a discount of 1.5. But if you are now paying within 45 days, it means that your benefit is going to reduce by this, and this is a cost to you. If your benefit is reducing, you are losing, and it's a cost to you. So there will be a cost of 0.004 million. And for that reason, KCCO should not go ahead with the proposal 1. They should not implement the proposal 1 because there will be a reduction of their there will be a reduction in their benefit by 0.04 million if they should go ahead to implement the proposal 1. Another way of doing this is to calculate the cost of you ignoring the discounts. You will see that the cost of you ignoring the discount will automatically be higher than the 15%. If it's higher than the 15%, then they should not ignore the discounts. But this one, the question says that you should calculate the cost savings or the net costs if you should go ahead. So this is how we do it. You take your current discount and you calculate the amount that you are paying within the 10 days. Then you ask yourself, if I should go to the bank and take this amount of money, what will be the interest that I will pay on it? And you calculate the interest. It means that since I'm using payables, I'm not going to pay this interest. Technically, you are enjoying this interest because you should have paid it, but you are not paying. So it's a benefit. So you add it to the discount that you are enjoying to have the total benefit. Then you now ask yourself, the new policy that they are saying that I should undertake. If I should undertake that I'm paying within 45 days, how much will I be paying within the 45 days? Okay, if I should go to the bank and take this amount of money, what will be the interest that I'll be paying on it? Calculate the interest. Then technically, since you are using payables, that is a benefit to you. You compare the new benefit now to the old benefit, the one that is higher. If the new benefit is higher than that one, it means that you are going to gain. You are going to have a gain. So go by the new policy. But if the benefit under the new policy now is lower than the benefit under the old policy, which is the current policy, then don't implement the new policy because you are going to lose. Your benefit is going to reduce. That is basically about payables management. Let's go to receivables management. Receivables management is also like this. It follows the same principle like the payables management, where you want to encourage people to pay early. So you also try to give them discounts. Or you ask yourself, if I should go and factor the receivables, you use factoring. Factoring means you are going to involve a third party to collect the receivables for you. So if you are involving a third party to collect the receivables for you, they will give you their terms. They are going to charge you, and that is a cost. They are going to give you some advance payment and those kind of things. So what you do is that if you want to determine whether you should factor or you should not factor, you look at the cost that you are incurring under the policy that you yourself you are implementing. You look at the cost that you are incurring under the policy that you yourself you are implementing. And you ask yourself, what will be the cost that if I should involve a factor? What should be the cost that I'm going to incur if I should involve a factor? What will be the cost? Then you calculate the cost too. Then you compare the cost for factoring and also the cost that you are incurring when you are doing the things on your own. Any of this is a cost. Any of them that is lower, you go by it. If the factoring is giving you a higher benefit, then you factor the debts. If it is giving you the opposite, then you go by your normal terms. Another way is to give the people discounts. If you are giving a discount is a cost to you. Then you ask yourself, if I'm giving them discount of this amount, this is what I'm going to be getting. But if I give them the discount, the number of days now will now reduce. If the number of days will now reduce and I'm going to take these receivables, going to take this money in the bank and be waiting that if the people pay, I'm going to pay the bank overdraft. What will be the finance charge that I'm going to get on it? Then you compare with that particular one. Let's look at receivables management. Then we move on to cash. Then we are done for today. Receivables management has to do with collecting receipts quickly to reduce the cost of financing debtor. So for receivables, what happens is that we are going to incur costs on it because our money are with people. So what we do is that we go somewhere because that money, we need the money to do something. So since the money are with people, we go to the bank. Mostly we use the bank overdraft interest rate. You go to the bank to take the money up to the money that the people are owing you to use it to finance your project. Anytime that you receive the money, then you use it to pay the bank. So always when your money is with the people, you have to go to somewhere and take the money to finance. Anytime that you collect the money, then you go and pay the loan that you have taken. So for receivables, we have interest. You pay interest on receivables, not the receivables, but the money that you are going to take to finance your project. Whenever the receivables come, then you go and pay. So we look at the financing factor for the receivables. We calculate a financing cost for the receivables. Another way is to extend the credit period to encourage additional sale. So sometimes when you are extending the credit terms, because normally we are saying that people should pay within 10 days. Now we are making it to be 20 days. It will encourage people to pay more because now the credit terms is now favorable to them or something. All right. Let's come to cost of receivables. What are the costs that you are going to incur when you are selling on credit? You can only have receivables when you sell on credit. So what are the costs? The first one is the administration cost to record and collecting the debts. So sometimes when people are owing you, you are going to engage someone that will be recording the number of debtors that we have. You are going to buy books and those kind of things. That is a cost to you. That's an administrative cost. The companies normally employ people to manage their receivables. They are going to be paying the person's salary, and that is an administrative cost. So you are incurring this administrative cost because you are selling on credit. You are employing the person to collect or to manage your receivables for you. So this is an administrative cost for you. Cost of irrecoverable debts. You are going to incur bad debts. If you are selling on credit, it means that at the end of the day, some people will go bankruptcy, some people will die, and you will not collect the money. And that is a bad debt for you. So bad debt is also a cost to receivables. Another one is cost of early settlement discounts. If you are giving the people that they should pay early, you are giving a discount. That particular discount is also a cost to the company. It's a company that is going to bear that cost. So discounts, cash discount, trade discount relating to receivables, or sales discounts are also a cost relating to receivables. You wouldn't have given this discount if you are selling on cash. You would have given this discount when you are selling by taking cash instantly. Although you are going to give discount, which will be a trade discount, but the discount that we are talking about over here is a cash discount. Discount given to encourage people to pay early. It's a cash discount, not trade discounts. Also, the finance cost, average receivables times the interest rate. The issue now is that people are holding your money. So you need that money to buy more stock. You need to replace your stock, and the money now are now with people. What are you going to do? Since you have the money, you go to the bank to take money and buy the inventory. If you are able to collect the receivables, then you go and pay the bank, and the bank will charge you interest, and that is the finance cost relating to the receivables. The finance cost relating to the receivables. So under the calculation of receivables, the only thing that you see is the change in policy. Change in policy. We are doing this, now we want to do this. What we do is that we calculate the cost under each of the policy. We compare any of them that is giving us a favorable position. We go about that one. We look at a question right now. Before you can sell to someone on credit, what are the factors that you are going to see before you decide to sell to someone on credit? Joycelyn, if you want to give your clothes to me on credit, what are the things that you are going to see before you decide to give your clothes to me on credit? What are some of the things that you are going to see? Joycelyn, you are a businesswoman here. You are a business person.
If you are credit worthy,
If I'm credit worthy.
your credit worthiness.
Okay. What does that mean? The credit worthiness. What are you going to see under the credit worthiness?
If I give you the goods and you're able to pay me back on time,
Yes.
or you have the capacity to take the goods and then let me have my money on the set dates that you have given me or time.
Okay, so you can use my past records to determine whether I've been paying on time or something like that. Then you give these things to me, isn't it?
Yes.
So if I have any dealings with you, you go back and check. The last time that you gave the cloth to me, how many days had it take me to pay you the money back? So based on that particular past record that you have about me, you can decide to sell to me on credit. Is that okay? All right. Austin, what are you going to see before you decide to sell to someone on credit? Austin, are you there?
Yes, sir.
What are you going to see before you decide to sell to someone on credit? Austin, I'm waiting. What are you going to see before you decide to sell to someone on credit? Austin, can you hear me? Elizabeth or Ben, what are you going to see before you decide to sell to someone on credit? Yeah, Austin, I can hear you.
Yes, sir. You mean what do you look out for before selling to someone on credit?
Yes, if you want to sell to someone, you have things that you are selling, and someone said that give it to him or her on credit. What are you going to see before you decide to give the things to that person on credit?
Well, first of all, you just have to check out past transaction with that person.
Okay.
If maybe he's able to go by his terms and condition concerning payment, and you also have to check his ability to pay. Yes.
Okay. That is nice. Yeah, Elizabeth, what are you going to see before you decide to give something to someone on credit?
First, you need to check if you can get the bank reference.
Okay. If the person is a worker,
Like if the person is owing and how does the person make his payment? No,
Okay.
you need to check in terms of his when owing.
Okay. All right. Another way, I can also decide to sell to someone by maybe asking his past people, like he's asking a third party, like if the person has a relationship with someone else, the person has been doing business with someone else, I can go and consult that person and say, oh, this person want to do this and this, I want to know. So you can also use references. Me self, I can also look at if you are a worker, what is your capacity? What is your salary range? If you are having the salary range of this, then it means that you can pay my money. But I can't sell to someone up to 10,000 if the person is receiving 1,500 every month. No, it doesn't make sense. The person cannot pay my money. So we are going to look at how we assess credit worthiness of a customer. Credit worthiness is a judgment about a credit assessment is a judgment about the credit worthiness of a customer. It provides a basis for a decision as to whether credit should be granted. If the credit risks, possibility that the debt goes bad is high, the customer needs to be managed carefully. The methods include bank reference. So banks are cautious as they owe duties of care to customer and inquiry. Therefore, the information about customer are limited. So what they do is that the bank also use confidentiality, the principle of confidentiality. So if you go and you are asking information about them, they can decide not to give you the information about the customer. So what you do is that you can request the customer to provide his bank statement. Then if you look at the bank statement, you see the number of loans that the company will be having, or you can also request for the pay slip of the customer. So you can also use the bank reference. We can also use trade reference. So trade reference has to do with you try to get information from a past supplier that the customer has dealt with. So if the person has dealt business with maybe Vodafone, you can go and ask Vodafone about that particular customer. How often do they settle their bills? How do they often settle their debts? You can also use that. You can also check the credit rating from the credit rating agency. You can also employ agency that do the rating. They will use a formula to do whether this person will be able to pay based on the information that you have provided. You can also do that. You can also do ratio analysis. You can also do customer visits where you are going to visit the customer's premises or his workplace to check whether they have the resources to, because when they don't pay the money, you can go and see some of the assets or some of something. So you have to see whether these people that are saying that they have a business, they actually exist. Another one is the press comments. What is the comment that they have about these customers? So if they are having negative comments about them in terms of settling debt, you will not go ahead to give them the goods on credit. So this, there can be a question that they will say, what are some of the factors that you consider before granting a credit to a customer? And these are some of them. You do a bank reference, trade reference. You also check the credit rating from credit rating agency, customer visit, press comments, ratio analysis, and the rest. Let's look at how we manage foreign account receivables. You see, if you're in Ghana, you can decide to sell to people in Togo. In that cases, you are dealing with someone who is using a different currency. How do you manage that? You know that the person is going to pay you in their currency. Then you change it to your normal currency. You are selling to someone in dollars. The person will pay you in dollars. Then you change it. It might happen that at the time that the person is paying you, the exchange rate might be going high, which will go in favor of that person and go against you. So how do you manage that? Company with foreign account receivables or exporters might have problems of large inventories and account receivables, and an increase in risks of bad debt due to the transportation time, and also additional paperwork involved in sending goods abroad. There are several ways for exporters to overcome these problems. Reduce the investment in foreign account receivables. So what you do is that the number of people that you sell to, if you are having 1,000, you can decide to reduce the number to 500. The foreign customer, you can decide to reduce the number to 500, reducing the bad debt risk. If you want to reduce the bad debt risk, what you do is that the people are not with you over here. They are in Togo. If you sell to them and you go there, they are not there again. They can run away, and that is the end of your money. So what you do is that you do credit worthiness. You assess their credit worthiness. If the person will not be able to pay you, don't sell to the person. If you don't sell to the person, there won't be any issue of the person not paying you. We can also do what we call export factoring. Export factoring. Export factoring, what you do is that you sell the foreign receivables to an expert and a factor in that particular country, and they will collect the money on your behalf. They will collect the money on your behalf. So we can also use documentary credits. Documentary credits, where you request a bank. You request a bank to issue credit in favor of the exporter. So you ask the bank to issue credit. The bank is just now telling you that, okay, we are sure that the people will pay you. We are sure that the people will pay you. Or you can ask the person's bank to issue the credit term. It means that if the person is not going to pay, the bank can use the money that the person is having with them to pay you. All right. Another one is we also have counter trade. Counter trade, where what you do is that you do what we call barter trading. I will give you this, then you also give me what you are selling. So I need that, you also need this. So what we do is that let's just exchange the goods. So that is also what we call counter trade. If you do that, your foreign receivables, the risk of you losing the foreign receivables and most of the money going out will reduce. You can also use what we call counter trade. And you can also use export credit insurance. So where you are going to insure the non-payment of foreign customers, you are going to insure them. If they are not going to pay, you'll be paying a premium to the insurance company. So if they are not able to pay, the insurance company will compensate you with the amount that they didn't pay. Let's look at what we call early settlement discounts. Early settlement discounts. Okay, early settlement discounts. So if you have early settlement discounts, what do we do? What do we do? You are now giving discount to the people to pay earlier than they should. What happened is that, let's pick a question. What happened is that if the people are now, if your current sales value is 60,000, and normally the people take 45 days to pay. They take 45 days to pay. And now you are telling them that you are going to give them a discount of 2%. If you give them a discount of 2%, they should be able to pay within 15 days. They should be able to pay within 15 days. They should be able to pay within 15 days. What are you going to do? Okay, so what you do is that you calculate your finance cost, and if the people are paying within the 45 days, how much are you paying as a bank interest? Assuming the bank interest rate is 8%. The bank interest rate is 8%. So if the people are paying within 45 days, how much are you paying as interest? If your total sales is 6,000 and people are paying within 45 days, what will be the receivables within the 45 days? How are we going to calculate that? How do we calculate that? How do we calculate that? Our total sales is 60,000. People are paying within 45 days. So how much are they paying within the 45 days? How do we calculate that, Austin? Joycelyn, how do we calculate that?
Our
Joycelyn,
total sales is 60.
our total sales is 60,000 and the people are paying within 45 days. So how much are they paying within the 45 days?
So I think 60,000 for the year, or
No. They are paying, our total sales level is 60,000, but it's taking the people, the receivables to pay, it's taking the 45 days to pay. So how much are they paying within the 45 days? It is same as the 45 divided by the number of days in a year times the total sales, the one that we did for purchases. So for us to know the amount that they are paying,
yes, so
the amount that they are paying, which we are going to pay interest on, will be the amount to give us. What will be the total amount that they are paying within that period? It will be, amount will be equal to 45 over 365 days,
365.
all multiplied by 60,000. How much are they paying?
7,397.
So 7,000.
397.
Okay, 7,397. So it means that the time that you sell, you have to wait for 45 days before you receive this amount, isn't it? But you need this amount to do other things. So what are you going to do? You go to the bank to borrow the money up to this level, so that if the people pay you, then you pay the bank back, isn't it? So if the bank is not charging you interest rate of 8%, so what will be the interest that you'll be paying to the bank? If the bank is not charging you interest of 8%, what will be the interest that you'll be paying to the bank? It will be the amount multiplied by what? The amount multiplied by what? 0.08. How much are you getting? How much are you getting? Austin, how much are you getting?
59.
Lizzie, are you there?
Yeah, I had 59.178.
Okay.
Yeah, 591.70.
Okay, let's make it
So
591.
592.
Okay.
Yes.
So we are currently, we
592.
are paying a finance cost of 592, isn't it? This is the cost that we are
Yes,
currently
please.
paying, isn't it? All right. Right now, we want to implement a policy that the people will be paying within 15 days and they will enjoy a discount of what? 2%. So let's now count the total cost under the new policy now. The total cost, the first cost will be the discount, isn't it? The discount that we are giving to the people is a cost to us under the new policy. What will be the discount amount? It will be 0.02 times the total sales, which is 60 what? 1,000.
1,000.
How much are we paying?
1,200.
1,200.
200.
You can now see that even the cost of the discount is even higher than
The finance
the
cost.
cost that we are paying first. Then, if the people are not paying within 15 days, then it means that we go to the bank to take the money up to 15 days and we pay interest for only 15 days, isn't it? So our finance cost
Yes.
under this one will be only 15 days, which will be calculated as 15 over 365 times the total sales, which is 60,000, times the bank rate, which is 0.08. What is the interest that we are paying under this one? What is the interest that we are paying under that?
197.
197. Okay, so our total
Yes.
cost under this method will now be what?
It will be 1,387.
So should they give the discount? Should they go ahead and give the discount? Should they go ahead to give the discount?
No.
No, because if we give the discount, we are incurring more cost than
No.
we should allow them to pay within
More cost.
45 days. Okay. This is the one way of doing it. You find the cost under each of the policy, then you compare. But another way of doing it is that if we are implementing the new policy now, the only cost that we are going to incur from the new policy will be what? Discounts. And the discount is how much? 1,200, isn't it? But first, what are we doing? We are asking the people to pay 45 days, then we are paying interest for 45 days, isn't it? But now we are giving a discount and we are asking the people to pay within 15 days. How many days interest we are going to enjoy now? How many days interest from the previous one we are not going to pay if we should implement a new policy? For how many days are we not going to pay interest for if we are implementing the new policy? How many days? Joyce, do you get my question? Or I should come again? Austin, do you get my question?
Yes, sir.
I should come again with a question. Okay. I'm saying that if we are giving a discount, the cost that we are going to incur is discount, isn't it? But what will happen is that first, we are asking the people to pay what? We are asking the people to pay within 45 days. It means that we go to the bank to take money up to 45 days and pay interest on it, isn't it? But right now we are giving a discount and we are asking the people to pay within 15 days. It means that we will go to the bank and take money up to 15 days, then we pay interest. So how many days from the previous days? 45 days. Now we are asking them 15 days. How many days interest are we not going to pay if we are implementing the new policy now? How many days interest are we going to save or we are not going to pay? How many days interest?
30 days.
30 days. It means that if you are giving a discount, you are going to save interest for 30 days, isn't it? So the discount is giving us a finance cost interest savings, which will be 30 days. If you're not giving a discount, you pay interest for 45 days. But if you're not giving a discount, you are going to pay interest for 15 days. It means that if you are giving a discount, you are going to save 30 days interest. So you now calculate the 30 days interest, which is a benefit to you, and compare with the cost that you are incurring, which is the discount. So let's look at the finance cost savings. Finance cost savings. Finance cost savings. That will give us the 30 days over 365 times 60,000 multiplied by the interest rate, which is 0.08. How much are we getting? How much are we getting?
394.5, so 395.
395. You see the benefit that we are getting and then the cost that we are incurring. Should we give the discount? Should we give the discount? The finance cost savings that we are making is 395. That is the benefit that we are getting. But the total cost that we are going to spend to get that benefit is 1,200. Should we go ahead to give the discount? Should we go ahead to give the discounts?
Uh,
Should we give the discounts?
no.
We should not give, because the benefit that we are getting from giving the discount is lower than the discount itself. I want to show you something. Find the difference between the cost. The first one that we did, 13,975 minus this one, and see the additional cost that you'll be incurring. If you are giving a discount, additional cost that you'll be incurring. 13,995, this is the total cost under the discount, minus the 592. What are you getting? Are you getting 805? Are we getting 805?
Yeah, 805.
So you can see that if you do it, this is the net cost that you incur if you want to use the savings. So you can do the two. Me, I will advise you to do the first one. You calculate the cost under all of them. But the second one, you determine the net cost savings benefits. It will be very hard for you. So just calculate the cost that you are incurring first, compare with the cost that you are going to incur and give it a discount. Then you look at it. They are all costs. If you are incurring less cost and are giving a discount, then you go ahead to give the discount. But if the cost and the discount is higher, then you not give the discount. Let's pick a question on that. Then let's see what we do. Then we go to the issue about factoring. Okay. Yeah, you will come. Are they around? Okay, let's look at this. Let's look at this question. Question 3. Let's solve this question 3 before we go to a question where we can pick issue about. I hope we are following so far. Are we getting what we are doing?
Yes, sir.
Okay. Joycelyn, are you okay? I'm not expecting receivables.
It's not very clear. It's not very clear, but I'm following.
Okay. It will be clear. Let's move on. I'm not expecting receivables to come anyways, because last sitting was receivables. But let's look at this question. The management of Lamara Co has annual credit sales of 20 million and account receivables of 4 million. Working capital is financed by an overdraft of 12% per year. Assuming 365 days in a year required, what is the annual finance cost saving if the management reduces the collection period to 60 days? So the first thing is they are having, you can see that the account receivable now is what, 4 million, isn't it? Okay, so you can check the number of days that we are going to receive this money, the collection period. How are we going to do it? It is the receivables over the sales times 365 days. So if you do that, how much are you getting? Currently, how many days is it taking them to pay? Currently, how many days is it taking them to pay? Currently, how many days is it taking them to pay? Receivable collection days is calculated as the receivables over credit sales times 365 days. So what are you getting? 4 million over 20 times 365. Currently, how many days is it taking them to pay? Do you have calculated?
73 days.
It's taking them what?
73 days.
73 days. And now the new policy now is what? They should pay within what?
60 days.
60 days. Would this give us a gain or loss? If we should reduce the receivables days, are we going
Let's see if
to
we calculate.
be losing or will be gaining? If we should reduce this to 60 days, it means that we won't give them 13 days again, isn't it? And the
Yes.
interest that we are going to pay, we are not going to pay interest for 13 days again, isn't it? If you are giving the 73 days, we pay
Yes.
interest for all the 73 days. But if you are not giving them 60 days, it means that the 13 days interest that you pay on financing that particular portion of the the receivables, you won't pay it if you are giving them 60 days. So you automatically gain. But how do we do it? You can do this in two ways. The first one is calculate the current finance cost that you are getting under current policy. What is the finance cost that you'll be paying? The finance cost will be the receivables figure. What is the receivables figure? What is the receivables figure currently?
20,000.
No, that is the total sales. What is the
4
receivables figure?
million.
4 million. So
Hey,
if we should
4
go to the
million.
bank and take this 4 million, what will be the interest that we pay on the 4 million? If we should go to the bank and take the 4 million, what will be the
Overdraft of 12%.
So it will be 12%. It will be 12% on the 4 million, isn't it? And what will be the
Yes.
interest?
Yes.
What will be the interest under the current policy?
480.
0.48 million.
0.48.
480.
Okay. Let's now come to the new policy. The new policy, we are now asking them to pay within what?
60 days.
60 days. So if you are asking them to pay within 60 days, then what will be the amount that you are going to receive in the 60 days? You have to calculate the amount yourself, isn't it? 60 over 365 times
Yes.
the 4 million. How much are we getting? Times the 20 million rather. 60 over 365 times the total sales, which is 20 million. How much are you getting now? You are getting 3.2 something. Are we all getting the same thing? 3.2 something. Are we all getting the same thing? Joycelyn, are you there?
Yes, 3.28 or 3.29.
So if you want to get the finance cost on it, you multiply that particular figure by the 12%, isn't it? So the finance
Yes.
cost that you'll be paying, if you should go to the bank and take that particular money to finance the receivables, how much are you going to pay? To be 12% on that amount. This can simply be calculated as 60 over 365 days times your sales, 60 over 365 days times your sales figure, which is 20 million. Then you multiply by the overdraft rate. So the first one will give you the amount that you'll be financing. Then if you multiply, then you get your finance cost. How much are we getting? How much are we getting? 0.3.
39495.
Okay. So what will be the net savings now? First, we are paying 0.48. Now we are paying 0.39. It means that we are going to have some savings, isn't it? The savings is what? 0.09. That will be the savings. If you want to do it, calculate the finance cost under the current policy, the new policy now. You can see that you are paying less compared to the old policy, which is the 73 days. You are saving interest of 0.09. Will you implement the reducing the this thing to 60 days? Will you implement it or you will not implement it? Are we going to reduce it to 60 days or we maintain the old one? Are we going to implement it? Joycelyn?
Yes.
Okay. If you want to, if looking at figures, we can implement, but you can also look at the effect of this on your sales. If this is not going to have any effect on your sales, then you can implement it. But if it's going to have effect on the sales, then you look at the effect on the sales and then the effect that you are getting from this one, then you know what to do. So sometimes, if you are looking at the figures like this, then you can implement. But if they have given you the effect of this reduction on sales, then you now look at what will be the effect on the sales. The effects that are the reduction that I'm getting on sales and the reduction that I'm getting on the finance interest, which of them is higher? If the reduction on the sales is higher, then I will just leave the thing to the normal terms. Another way of you calculating this net savings cost is to look at the reduction, the net savings cost. First, we are giving the 73 days. Now we are giving the 60 days. It means that we won't pay interest for 13 days. Then you can go ahead to calculate the interest on that 13 days. That is the savings. So you look at the finance cost for that 13 days. Then 13 over 365 times the total sales 20 million. Then you multiply by the bank interest rates. So it means that since we are reducing the collection period now to 60 days, it means that the interest that we were paying first based on 73 days, we won't pay 13 days of that particular interest again. And that becomes a savings to us. That becomes a gain to us. So let's calculate the finance savings relating to that 13 days. How much are you getting? You should be getting 0.09 something. How much are you getting? 13 over 365 times 20 times 0.12. Jocelyn, what are you getting? Jocelyn, what are you getting? You get 0.085 something. They are the same, isn't it?
Yes.
Okay, so instead, this one you can decide to look at the finance cost under the two. So if you're implementing the new policy now, what is the finance cost? Then the old policy, then you see that okay, you are saving cost. Another way of doing it is that if I'm asking them to pay 73 days, it means that I would pay interest for all the 73 days. Now that I'm asking them to pay within 16 days, it means that if I should maintain the 73 days, I would have paid additional interest for 13 days. But now I'm reducing it. What is the interest that I should pay for the 13 days that I won't pay? That is a savings to you. You can go ahead to calculate that. Let's look at a question. Let's pick a question. Let's pick one question on the receivables. Then we move on. Let's look at a question on the receivables. Then I want to pick a question on factoring and also. Okay, let's pick one question on factoring and also the receivables is always changing policy. Okay, let me just give you a format of how you talk about a change in policy. Okay, if you have the current policy, you calculate the finance cost of receivables, early discount cost. You just calculate all the costs under your current policy now. Then the proposed policy is the new one. You also calculate the total cost that you are going to incur there. Then you compare the one, which of the costs is now higher. If the current policy cost is higher than the proposed policy, it means that you should go by the proposed policy. If the proposed policy cost is higher than the current policy, it means that you'll be spending additional costs. So go by your current policy. That's how we do the two. Let's talk about factoring, debt factoring. I've spoken about this under source of business finance, but we'll talk about it again. If you talk about debt factoring, it means that we are giving our receivables to a professional debt collector to collect them for us. So what we do is that we give the receivables, we sell it to a professional debt collector to collect the debt. So what we do is that we go there and sell it to them, but we don't sell it at a full amount. You always sell it less than the amount. You can sell it for 80% of the amount that the people are owing you, and you give it to the debt collector that they should go and collect the money. So you have taken the money already. That is the factoring. So you sell the receivables to someone who is a professional debt collector, and the person will collect the money on your behalf. But what normally happens is that if you go and sell the money to the person, you go and sell the receivables to the person will just give you your money, and that is the end. Whether the person will be able to, if you are selling the thing for 8%, the people are owing you 100,000. And the debt collector is saying that they can only give you 90% of this amount. If they are giving you 90% of this amount, it means that you are going to receive only 90,000. Isn't it? You receive only 90,000. Am I correct? All right. Receiving this 90,000 is a final money that you are receiving. You won't come and say that you are coming to receive the remaining 10,000. No. As soon as you receive the 90,000, that is the final one. You won't receive any money again. And what you do is that you write the remaining 10,000 as a bad debt. You will not receive it again. So if you sell the receivables to the people and they give you an amount and that is a final payment, you don't receive any further amount again. And whatever happened with the receivables is not your business. That is what we call factoring without recourse. Factoring without recourse. So we have two types of factoring. That would be factoring without recourse. Factoring without recourse. So factoring without recourse is where if the debt cannot, the part of the debt cannot be collected, the factor will not claim anything against you. He will not come after you. That is factoring without recourse. They will give you the money and that is the final payment. So what you do is that the remaining portion of the debt that you are not receiving, you write it off as a bad debt. Another thing is that the factor will say that, okay, we will give you 80,000 as an advance payment. If we are able to collect the remaining 20,000 within 30 days, then we give you the 20,000. But if you are not able to collect the receivables within 30 days, then you pay the amount given to you plus interest. If that happens, this is what we call factoring with recourse, where the money given to you will be seen as a loan. The money given to you will be seen as a loan, because if the people are not able to collect the money within a stipulated time, they will come after you. You will pay the money given to you and in addition to interest. So in this case, you are not going to write off your debts, but you are going to treat the amount received from the factor as a loan. As a loan. We look more under this for people who are doing financial reporting. This is under financial instrument. All right. So factoring without recourse is where you are going to receive money and that is the final receivable. Whatever happened, whether the factor is able to collect all the money is none of your business. But factoring with recourse is where the money will be given to you as an advance, where they will tell you that if we are not able to collect the money, we will come for our money with interest. If they are able, then they will give you the balance. This is what we call factoring with recourse. Let's look at factoring. If you look at the factoring, the administration cost, factoring without the recourse, the administration cost and everything, credit quotation and those things are with the factor. Whatever happens, what amount that they are going to spend to get the money is none of your business. It's none of your business. All right. Let's look at what we call invoice discounting. The two comes together and they can ask you to differentiate between them. Invoice discounting is using the receivables as a collateral security to take advance payments, to take loan. So what you do is that you go to a bank or financial institution and say that, okay, you present the receivables to them that people are owing me this amount of money. So I want to use this as a collateral security so that you can give me a loan of this. You can't receive more than what the people are owing you, because you are saying that you are going to use the amount that the people are owing you to pay. So they will give you an amount relating to that. Always what they do is that they will discount it. The amount that you are having right now is the amount that you are going to collect from the people in the future. So they will use the interest rate to discount that particular amount to the present value and give you the present value of the amount that the people are owing you. So that whenever you collect the money and the time that you are going to pay, the interest that you are going to pay on the amount will increase the present value and you have the future value now. So that is what we call invoice discounting. You are using the receivables as a collateral security to take loan. But what happens is that the people are going to use their interest rate to discount to present value the amount that they are saying that people are owing, so that before you receive the money, the interest will add up to the amount given to you. Then you have the future value and you give it to them. That is the invoice discounting. Let's look at some questions under receivables management. Then we look at cash management. Then we are done, ladies and gentlemen. Let's move on. Okay, let's look at question 5. Question 5, let me see. Okay, should I solve this one as the last question? Okay, let me just solve the question 5. Let's look at question 5. Who is reading for us? Jocelyn, read for us. Okay, Elizabeth, read for us.
You could had annual. Sorry, I'm moving.
I've left there. Okay.
Eco has annual sales revenue of 6 million, and all the sales are on 30 days credit. Although customers on average take 10 days more than this to pay. Contribution represents 60% of sales, and the company currently has no bad debt. Account receivables are financed by 1%. You code plan to offer an early settlement discount of 1.5 million for payment within 15 days and to extend the maximum credit offer to 60 days. The company expects that these changes will increase annual credit sales by 5%, whilst also leading to additional incremental costs equal to 0.5% of turnover. The discount is expected to be taken by 30% of customers, with the remaining customers taking an average of 60 days to pay required. Evaluate whether the proposal change in credit policy will increase the profitability of UCO
Okay. So
standard.
okay. So what we are going to do right now is that we should look at what is their profit under the current policy. Then we also come and look at what is the profit under the proposed policy now. Then we look at the profit, then we know what to do. So you can see that they say that the question is the company is currently having annual sales revenue of what? 6 million, isn't it? And all sales
Yes.
are on 30 days credit, although customers on average take 10 days more to pay. So on this case, if you want to finance the receivables, how many days are you going to finance these receivables? How many days are you going to take the loan for? Is it going to be 30 days or how many days?
Early settlement 15 days.
It will be how many days? Joycelyn,
Say the question again.
yeah, read the question. They are saying that the all sales are on 30 days credit, isn't it? Although customers on average take 10 more days to pay. So the standard rate is 30 days, but the people are taking what? 10 days to pay. If you want to go to the bank to go and borrow money, will you borrow money that will take you for 10 days, or
10 days.
will you borrow money that will take you for 30 days, or you borrow that will take you for more than 30 days? How many days are you going to take the money for? Elizabeth, how many days are you going to take the money for?
30 days.
No,
30 days.
No.
Instead of the 10 days. Because
no, that if you take it 30 days, the customers will not pay within the 30 days. They will still take additional 10 days. So the customers will pay you in 40 days. So you have to go to the bank and take the loan for 40 days.
this.
You are just giving that they should pay within 30 days, but they are not taking 10 days more. So if you are borrowing the money for 30 days, it means that you won't have money to finance the remaining 10 days that it will take them to what? To pay. So the question will always give you the standard rates, but they will also give you the customer take more than this. Just add the more days to the standard days to give you the number of days that is taking the customers to pay. It is taking the customer 40 days to pay. It is taking the customer 40 days to what? To pay. Justin, are you okay now? Jocelyn, are you okay?
Per your explanation, you were saying I'm saying that per your explanation,
Yeah.
like you were saying something that instead of the 30 days, they were taking 10 days to pay.
They are taking them 10 more days. So in all, it is taking them 40 days.
The explanation that you made.
Yes, I'm saying that they are taking, although they should pay 30 days, but they are taking 10 more days to pay. It means that on average, the customers are using 40 days to what? To pay. So if you want to go and borrow money, go and borrow the money that will cover you the 40 days. But if you borrow up to 30 days, the customers will not pay on the 30th day. It will still take them what? 10 days. So the money that you borrow for 30 days will not be enough for you. You have to go and borrow additional what? 10 days because the customers will pay after the 30 days has elapsed. It will take them additional 10 days again. So in all, they are paying within 40 days. So you have to borrow the money up to what? 40 days. Are you okay now?
Yes.
Okay. So under the new policy, they don't have any bad debt. The only cost that they are incurring is the finance cost relating to the borrowing, that 40 days borrowing that they will use to finance the receivables, isn't it? And the question is saying that the contribution represents 60% of sales and the company has no bad debt. So currently, 60% of the sales is what? Contribution. Let's look at the current policy. Let's look at the profit under the current policy. The profit under the current policy is what? The contribution is what? Contribution is what? 60%, isn't it? So 60% of sales is how much? 60% times the sales, 6 million. How much are we getting? How much are we getting?
$3,600.
3.6, isn't it? All right, 3.6.
Yes.
So this is our contribution, but what are we going to do? We pay finance costs for borrowing the money for 30 days, for 40 days rather, to finance our receivables. So how do we get a finance cost? It is calculated by the 40 days over 365 times the annual sales. What is the sales? 6 million. Then this multiplied by the what? The bank interest rates. What is the annual interest rate? 7%, isn't it? Multiplied by 0.07.
Yes.
So an account receivable are financed by an overdraft at an annual interest rate of 7%. So what would be the finance cost under this? 40 over
0.046.
Okay. I'm coming. Let me confirm. 0.05. Can we make it like that?
Yes.
0.05. So what will be our total profit now? This is a cost, isn't it? So we subtract the cost of that. So this minus this. What are we getting? 3.55. So under the current policy, our profit is what? Under the current policy, our profit is 3.5. Let's count to the proposed policy. What will be the profit under our proposed policy? Proposed policy. So proposed policy, we should start with the contribution that we'll be getting, and we subtract all the costs. Okay. So we are done with the profit under the current policy, which is the old policy, 40 days. Account receivables are financed by overdraft. Okay. Unico plans to offer an early discount of 1.5% for payment within 15 days and to extend the minimum credit offer to 60 days. The company expects that these changes will increase annual sales by 5%. So what will be our annual sales now under the proposed policy? What will be our annual sales under the proposed policy now? It means that the 6 million will increase by 5%, isn't it? The 6 million will increase by what? 5%. Joycelyn, am I okay? Elizabeth, are you okay with that side? The company expects that these changes will increase the annual credit sales by 5%. It means that the sales that we have at the beginning, which is 6 million, will now increase by 6.5, and that will give us how much? That will give us how much? So for you to do this, you can just have 1.5 times what? 6 million. How much are we getting?
I have 6.3.
6.3. Joycelyn, I'm also getting the 6.3. Are you also getting the 6.3? Another way of doing it, just increase the 6 million by 5%. The answer that you get, then you add it to the 6 million again. Have you gotten something like that? All right. So our annual sales now under the proposed policy is 6.3 million. What would be our contribution now under the proposed policy? what will be the contribution now? It will be 60% on what amount? 60% on what amount? The contribution of the company is 60%.
6.3.
It will be on the new
So
sales now,
6.3.
6.3. And that will give us how much?
3.78.
3.78. So our new contribution is 3.78. So let's now take the cost one by one. What are some of the costs that we are going to incur under the new policy? The first one is discounts, isn't it? The first one is what? Discounts. The discount is what? What's the discount rate?
1.5.
So that will give us 0.015.
1.5.
1.5, which will give us 0.015, isn't it?
Right.
And this discount will be on which figure? It will be on the total sales now for this particular policy, which is 6.3 million. Are we correct?
3.
Okay. So what will be the discount
Yes.
amount? What will be the discount amount? 0.015 times 6.3 million. How much are you getting? I'm getting 0.09. 0.09. Am I correct? So 2 decimal places, 0.09.
Yes. Yes.
Okay.
You are correct.
Okay. Let's come now. What are the additional costs that you are going to incur? This will also lead to an incremental cost equal to 0.05% of turnover. So let's deal with that incremental cost too. Let's deal with that incremental cost. Let's deal with that incremental cost. Okay. Let's deal with the incremental cost. What will be the incremental cost? Incremental cost will be 0.005 times the turnover. The turnover is now 6.3. Am I correct? That will give us how much? How much are you getting? I'm getting 0.03. Am I correct? Joyce, are you there?
So you are correct.
Okay. Okay. Are you sure that you are following? Joyce, are you sure that you are following?
Yes.
Okay. Let's move on. All right. So we are done with the incremental cost now. But what will happen? You will see that they are going to pay finance cost now, isn't it? The finance cost will be paid in 2 ways. One will be paid within 15 days, and one will also be paid within what? 30 days. Because they will offer a discount for 15 days, and they will also extend the maximum credit offer to 60 days. But what is happening? 30% of the customers are taking what? The discounts, and the remainder, which is the 70%, are also taking the average 60 days to pay. How do we know the number of people that are paying within the 30 days? What is our annual sales? Our annual sales is 6.3 million, isn't it? That is our annual sales under the new policy now. Am I correct? All right. So that is our annual sales now. But 0.3 of this annual sales will be paid within 15 days. So you find 0.3 over this, then that will be the sales for the 15 days. Then you now find 15 over 365 times the 0.3 of this. Another way of doing this is you do it like this. Finance cost for the 15 days. Finance cost for the 15 days is equal to the number of people that will be paying within that. That will be 0.3%. 30 days of the sales. The 30 days of the sales, which is now 6.3 million. Then you multiply by how many days it taking these people? It is 15. 15 over the total number of days, 365. Then this is the amount that you are going to take within that particular date. What is the interest rate on this? 0.075. This is how you do the first finance cost for 30 days, for the 30%. So you find 30% of the annual sales level that represent the total sales for the 15 days. So how much are you going to take within the 15 days? It will be the 15 over 365 times the amount that you have gotten, which can also be calculated like this. Then you just multiply that by the interest that you are going to pay on that particular amount that you are going to collect within 15 days. This is how we do it. What is the amount that you are getting there? 0.3 times 6.3 times 15 over 365 multiplied by 0.07. Jocelyn, how much are you getting? Getting 0.04. 5 rather. You can see that you are getting 5 point something 10 exponent negative 3, isn't it? Jocelyn, is that what you are getting on your calculator?
Yes, when I talk, you can't hear. My network is bad.
So that is what you are getting the calculator. The negative 0,
Yes.
the negative 3 over there means the 0 should count 3 times. So 0.00, that is 30. Then before you bring the 5, that is the first finance cost. The next
Yes.
finance cost also relating to the 70 days will be calculated like this. Then how many people are paying within that period? It is 70%. So 0.7 times the total sales, 6.3. How many days is it taking these people to pay? 60 days. Then you have 60 over 365 multiplied by the interest rate, 0.07. What are we getting for that one too? 0.7 times 6.3 times 60 divided by 365 times 0.07. What are you getting? I'm getting 0.05. Am I correct? Auntie Jocelyn, am I correct? Okay.
Yes.
Okay, so we will now subtract all the costs from the contribution margin and see whether it is giving us a higher profit or it is giving us a lower profit. Then we now decide. So what is happening? Is our profit increasing? Under the new policy, is our profit
Yes.
by how much? So
Let
you
me
find the
let's have a
difference.
calculation.
You find the difference and you say that, okay, the company should go ahead with the new policy because it is increasing their profit by the difference, which is a 3.605 minus a 3.55. So they should go ahead to implement the policy. You can also do this in a different way. You see, you can also do this in a different way. What you do is that you look for the increase in your contribution, but I don't have time, otherwise I'll do it. The increase in contribution. The increase in contribution now will be the increase in the sales. So what will happen is that our sales is increasing by, you can say that sales is increasing by 0.3 million, isn't it? Our sales is increasing by 0.3 million, which is 300,000 because the sales under the current policy was 6 million. Under the new policy, that's now 6.3. So the sales is increasing by 0.3 million. What you do is that you calculate the contribution, the additional contribution now, which will be 0.6 on this. Then you get the increase in your contribution, which will be 0.18. That is the increase in contribution. You can also see that 3.78 minus 3.6 is the increase, which is the difference between the contribution, which is the same as the 0.8. Then what you do now is that this is the increased contribution. What is the cause that this increased contribution is bringing? What is the cause that they are bringing? It is bringing a discount. It is also bringing an increase in an incremental cost of 0.05. So you net that 0.09, which is the discount. You net it because the new one is coming. These costs are coming with the proposal. So you do this like this. You count the incremental cost also. 0.03. Then you now come to the savings under the finance cost. If you are giving a discount, this is now the finance cost that you'll be getting. This is now the finance cost that you'll be getting. So the two finance costs will be 0.05 plus 0.005. Under the new policy, these are the finance costs that we are incurring. But what is the finance cost that we are incurring first? That was 0.05. So minus 0.05. The difference that we are getting now is the additional finance cost that we are going to incur now will be holding this, because we are already incurring this under the old policy. The new policy, we are also incurring this, so this will not come with anything. So what you do is that you find the increase in your finance cost, or you find savings in your finance cost by calculating the total finance cost under the new policy. You compare with the finance cost that you have under the old policy, by how much is the finance cost increasing. That will give us 0.005. Then you now subtract all this from the increased contribution, which is the sum of this, sum of all of this, which will give you your figure, which is 0.005. Look at this. This figure minus the old profit. What are you getting? You get the same thing at the end. You get the same thing at the end. But for you to determine these things one by one, it is a matter of something. It's your ability to interpret it. It has to do with the ability of you interpreting it. So the basic way of doing it is that you just calculate the profit under the old policy, then you now calculate the profit under the new policy. You compare the two. Don't go and confuse yourself with anything. Just like, okay, do the one that you like. If you can't be able to deduce what I have done over here one by one, then just use the old one that you know. Calculate the cost under or the profit under the old policy. You calculate the profit under new policy also. I also want to show you this thing. This finance cost that we have calculated over here, we can also calculate it in one way by using a weighted average, the weighted average number of this. What we do is that for us to calculate the weighted average number of this, what we do is that we have 0.3 times the 15 days. That is 30% to pay within 15 days. Then we add the second one. So 30% will pay within 15 days. So if on average, how many days are they paying? We find 30% on the 15 days. Then you also come to the 60 days. How many percent will pay? 70%. So it will be 0.7 times 60 days. Then you now add the two to know your average, the weighted average number of days. So 0.3 times 15 days, I'm getting 4.5 days. 4.5 days. Then I'll now add the 60 days. So 0.7 times 60. I'll get 42 days. If I add the two, I'm getting 46.5 days on average. So if I want to calculate my finance cost, what I'll do is that I'll just use 46 days to calculate the finance cost. So what I'll do over here is that my finance cost will be 46.5 over 365 times 6.3 million, which is the sales, multiplied by the finance interest rate, which is this. If you do this, you get the addition of these two figures. Let's try that. 46.5 divided by 365 times 6.3 multiplied by 0.07. I'm getting 0.056. Let's add these two finance costs and see something. 0.005 plus 0.05. I'm getting 0.055. Is the approximation that is making them not to be equal. So any one that you can do it, just do it. Let's look at another question under the receivables management, then receivables, I'm not expecting the receivables to come anyways, but let's look at where the entity will decide to factor, the receivables. Let's look at where the entity will decide to factor the receivables. Okay. Average receivable collection period is 2 point. Let's look at the question 9. Let's look at question 9. Who is reading for us? Question 9. Auntie Lizzie, can you read for us? Let me, this thing is the Auntie Lizzie, try it and see whether you can read. Auntie Jocelyn's network is very bad.
Question 9.
Yeah.
Special Gifts Supplies Company is a wholesale distributor of a various varieties of imported goods to a. Sir, can you zoom it for me?
I should zoom in.
Okay, it's okay now. Special Gifts
Or it's too much.
Special Gifts Suppliers. No, reduces the size for me.
I should
It's okay.
increase it.
It's okay.
It's okay now. Okay.
No, it's okay.
Okay.
Yeah. Varieties of imported goods, a range of retail outlets. The company specializes in supplying ornaments, small works of art, high value finishing, and other items that the chief buyer for the company feels would have a market. In seeking to improve working capital, the financial controller has gathered the following information. Average period for which items are held in inventory is 3.5 months. Average receivable collection period 2.5. Average payables payment period 2.0. Required. Calculate special gift supplies funding requirements for working capital measured in terms of the month.
Let's look at the first one first. So what will be the working capital requirements in months? How do we calculate working capital? Is the current asset minus current what? Liabilities, isn't it? Is that how we calculate
Yes.
working capital? Auntie Lizzie, how do we calculate working capital?
It's going to be your your trade, like the inventory plus receivables, you less your payables.
Okay. So basically, working capital is calculated as current assets minus current liabilities. So we do the same principle over here. So we assume that the number of this, the month, and these ones also represent figures for the inventory and this one. So if you want to know your current asset over here, it will be 3.5 plus 2.5. What are you getting? 6, isn't it? Then we now subtract our payables from it. So 6 minus 2, that will be 4 months. So the working capital requirement in terms of months is 6 months, which is 3.5 plus 2.5 minus 2.0. Are we okay? Let's look at the second part. Let's look at the second part. Auntie Lizzie, in looking to reduce the working capital funding requirements, let's move on.
Okay. In looking to reduce the working capital funding requirement, the financial controller of special gift suppliers is considering factoring credit sales. The company's annual turnover is 2.5 million Ghana cedi, of which 90% are credit sales. Bad debts are typically 3% of credit sales. The offer from the factor is conditional on the following. The factor will take over the sales ledger of special supply. The factor will take over the sales ledger of the special gift supply completely. 80% of the value of credit sales will be advance payment as soon as sales are made to the customers to special gift supply. The remaining 20% will be paid to the company 1 month later. The factor charges 15% per annum on credit sales for advancing funds in the manner suggested. The factor is normally able to reduce the receivable collection period to 1 month. The factor offer a no remorse facility whereby they take on the responsibility for delaying with bad debt. The factor is normally able to reduce bad debt to 2% of credit sales. A charge for factoring service of 4% of credit sales will be made. 1 month, a day of payment of 25,000 Ghana cedi is payable to the factor. The salary of the sales ledger administrator, 12,500, will be saved under the proposed and overhead cost of the credit control department, amounting to 2,000 per annum, will have to be reallocated. Special gift supplier cost of overdraft finance is 12% per annum. Special gift supplier pays its sales force on a commission only basis. The cost of this is 5% of credit sales and is payable immediately the sales are made. There is no intention to alter this arrangement under the factoring proposal required. Evaluate the proposal to factor the sales ledger by comparing special gift supply existing receivable collection costs with those that resulted from using the factor, assuming that the factor can reduce the receivable collection period up to 1 month. C, as an advisor to special gift supply co, write a report to the financial controller that outline how a credit control department might function, benefits of factoring, and we have financing of working capital can be arranged in terms of short-term and long-term source of finance. In particular, make reference to the financing of working capital or net current sales, a current asset, when short-term source of finance are exhausted. The distinction between fluctuating and permanent current assets.
Okay. So this is what they are saying now. Currently, how many months is it taking the customers to pay the company? Currently, how many months? Currently, how many months is it taking the suppliers, the customers to pay the company? Currently, how many months is it taking them?
2.5.
2.5 months, isn't it? Okay. 2.5 months.
Yeah.
Okay. So what will be the annual sales? Currently, what is the annual credit sales? Only credit sales that brings receivables. If you don't sell on credit, nobody will be owing you. So they say that 90% of the sales are what? Credit sales. But what is the actual level of the sales now? What is the actual level of their sales now? It's 2.5
The turnover is 2.5. Yes.
So if you want to know the number of credit sales, the amount related to credit sales, it will be the 90% times what?
2.5.
The 2.5, which is 2.5. Okay. So let me use all the figures. So that's 2.5 million. How much are we getting?
2.25.
2.25. So annual sales,
5.
annual credit sales will now be annual credit sales will now be, so annual credit sales is now 2 point what?
2.25. 25.
Okay, so that will give us 225, 250,000. Okay, let's come now to the cost under the current policy. What is their cost? What is the cost that they are currently incurring under the current policy? The first cost is the bad debt, isn't it? What is the bad debt that they are incurring currently? In looking to reduce the working capital requirement, the financial controller of the special is considering factoring credit.
3%.
Okay, it's 3%.
3%.
So currently their bad debt is 3%, which is 0.03 times what? Say,
2.25.
okay, 2,500, 2,250,000. What is the figure? What is the figure?
At 0.0675.
Do it,
Or I
do
should
it.
do the full amount.
Yeah, do the full amount.
67,500.
67,500.
Yeah,
Okay.
67,
That is the first cost
500.
that they are
Yeah.
incurring. They are incurring a bad debt of what? 3% of the credit sales. Okay.
3 million. 3%. Yeah.
Okay. So the offer from the factory, all these things are concerning the factory. Let's go and look at some of the costs that they are incurring. Some of the costs they are incurring currently under the current post, the current policy. Let's look at the costs that they are incurring under the current policy. If you read the question, they say that they pay commission, isn't it?
Yes.
So if you look at this, all these things are relating, those one with the points, they are relating to the factor. But let's come to this place. The salary of the sales administrator, 2,500 will be saved under the proposal, and overhead cost of credit control amounting to these two per annum would have to be what? Reallocated. This is telling you that
Allocated.
this is telling you that currently they are paying a salary to sales ledger administrator 12,500, isn't it? And they are also incurring an overhead cost of the credit control departments. So you have to come and add those costs, or they are now paying a salary to that person. So if they factor, this salary will not be paid again. If they factor, this salary will not be paid again. If they factor, this salary will not be paid again.
Yes.
So we have a salary of this. So another one is the overhead cost. What is the overhead cost? The overhead cost is 2,000 per annum. Okay.
2,000.
Okay. So these are some of the costs. Let's come again. Special gift suppliers, suppliers pays its sales on a commission only basis. The cost of this is 5% of credit sales and is payable immediately the sales are made. There's no intention to alter this arrangement under the factoring proposal. So it means that both under the factory and this one, they will still pay the commission, isn't it? And what is the commission amount? What will be the commission amount? What will be the commission amount? 0.05% times the sales. What is the sales? 225,000
112,500.
1,
11,
1, 2, 500. So currently, this is the total cost that they are incurring under the new policy. So this is the cost. Let's come to the proposed policy, which is the factoring now. Okay, sorry. They are going to incur finance costs. Sorry. They are going to incur finance costs. So finance costs will be, how many months is it taking them to pay now? It's 2.5, isn't it?
yes,
Okay, so the finance cost will be 2.5 months divided by 12 times the number of credit sales times the amount of the credit sale, which is 50,000 times the overdraft rate. What is the overdraft rate in the question?
over
It's 12%, 0.12. So what will be the interest amount? How much are you getting? I'm getting 56250. Is that correct?
56250.
Okay. Okay, so this is the total cost now they are incurring. Let's come to the proposed policy. Proposed policy, which is the factoring. Okay. So we now look at the cost that will be incurred under the factoring. The cost that will be incurred under the factoring. The cost that will be incurred under the factoring. The cost that will be incurred under the factoring. Let's take those costs one by one. Okay. The factor will take over the sales of this one completely. 80% of the credit sales will be advanced immediately as soon as the sales are made to the customer to special gift suppliers. The remaining will be paid to the company 1 month later. It means that whenever we sell, they will give us 80% of the sales, isn't it? But they will give us the 20% in 1 month later. What is the meaning of that? It means that we have to go to somewhere to borrow the amount of money that is relating to what? The 20% of the sales in 1 month. Because they will give us 80% now. This sales figure, they will give us 80% now, but 20% will be given to us in 1 month's time. So what are we going to do? We have to go elsewhere to borrow the 20% of this amount and pay the people in 1 month's time. So the finance cost over here will only be for 1 month, which is the money. If they will give us 100% of the sales immediately, it means that we won't go anywhere to go and borrow. We are going to have all the sales amounts now. All the money that we sell, they will give us all the amounts. But since they are saying that they will give us 80% now, it means that we have the money now. We won't go anywhere and go and borrow. But the 20% will be given to us in 1 month's time. It means that we have to go elsewhere to borrow the 20% of the sales, and we pay the people in 1 month's time. So the finance cost over here will only be in 1 month's time. How do we do that? This will be 0.2 times the total sales, which is 225,50,000, multiplied by 1 divided by 12. This is the amount that we are going to take times the bank overdraft rate, which is 0.12. What will be the finance cost? What will be the finance cost under this? I'm getting 4,500. I'm getting 4,500. Is that correct? Auntie Joyce, am I correct? Auntie Elizabeth, am I correct? Auntie Joyce and Elizabeth, are you people here?
Yeah, you are correct.
Yes, you are correct, sir.
Okay, that is the first part. The FATA charges 15% per annum on credit sales for advancing funds in the manner suggested. So what will happen? What will happen? It means that they are going to charge us interest of 15% on what? The credit sales. What is our credit sales? We calculate the interest, which is 0.15 times our current credit sales. So we have the finance charge will be 0.15, which is the interest percent, multiplied by our current credit sales, which is 250,000. How much are we getting? How much are we getting?
$33, 7,500.
Okay. Okay, so this will be 337,500. Am I correct?
Yes.
Yes,
Okay.
you are correct.
Let's come to the next one. So those are the FATES offer no recourse facility where they take on responsibility for dealing with bad debts. So it means that, okay, the FATA is normally able to reduce bad debt to what? 2% of credit sales. Although we are factoring, we will still incur some portion of the bad debt, isn't it? So what will be the bad debt that we are going to incur now? What will be the bad debt that we are going to incur now?
2%.
2% of what? The FATA offers a no recourse facility where they take on responsibility for dealing with bad debts. Where they take on the responsibility for dealing with bad debts. The FATA is normally able to reduce bad debt to 2% of credit sales. So what amount are we going to charge the bad debt on now?
On the 5,000.
No. The FATA is giving us 80% of the sales immediately. Will there be a bad debt on the 80% amount that they have given to us?
No.
So what amount would the bad debt be on?
The 20% of
The 20%. Are you okay now? So bad debt will be on only the 20%.
Yes.
Because they are giving us 80% as soon as the sales will be made. And the FATA, they are giving us this one on no recourse. No recourse. No recourse. It means that whatever happened with the money is none of their business. So the money that they have given to us, whether there's a bad debt or not, they will not take the money back. But if they are giving us a factoring with recourse, it means that if they're not able to collect all the money, we pay the money back to them. So in this case, we have to take the 2% bad debt of all the sales that we are going to make. But in this case, this is a factoring without recourse. So since they are giving an advance of 80% of the sales amount, what will happen is that we will pay bad debts on only, we will incur the bad debt only on the amount that the remaining advance, maybe 2% of that, we won't get it. So if you want to know the bad debt, it will be 0.02 times the 20% of the annual sales, which is 2 to 50,000. What is the amount that we are getting? I'm getting 9,000. Is it correct?
Yes, 9,000.
Okay.
Yes.
Okay. A charge for factoring service of 4% of credit sales will be made. Okay. This one, let's look at this. You see the 15%. The 15% is what? The 15% is per annum, isn't it? The FATA charges 15% per annum on credit sales for advancing funds in that manner. The FATA is normally able to reduce the receivable collection to 1 month. So how many months are they going to use to collect the money?
1 month.
So the interest should have been for only 1 month. Are you okay? The interest should have
Yes.
been for only 1 month because they're not using a full year. They are charging this one 15% per, but yeah, they are going to collect the money for us for only 1 month. So they have to charge only 1 month interest. Sorry. So we have this multiplied by 1/12. Are we okay now? So multiply this amount that you have gotten by 1/12. The 337,500 times 1/12. How much are you getting? I'm getting 28,125. Can we move on? Can we move on?
Yes.
Okay, let's move on. Okay. A charge for factoring service of 4% of credit sales will be made. So charging factoring service, their factoring services will be 4% of the what? The credit sales. Charge of 4% of credit sales. That will be total credit sales. So we will charge that on the total sales. So 0.04 times the 225. How much is that? So 0.04 times 225,000. I'm getting 90,000.
Yes, that's all of that. 90,000.
90,000. Okay, let's come here. One-off payment of 25,000 is payable to the FATA. So one-off payment is also a cost coming from the factory. So one-off payment is 25,000 to the FATA, 25,000. Let's come again. What are we going to incur the administrative costs and overhead costs under the factoring to? No. Because if we FATA, those costs will not be incurred. But if we FATA, we will still incur the commission, isn't it? If we FATA, we will still incur the what? The commission. So we still have the commission of that particular amount, 112,500. So let's find the total cost under the factoring now. If I finish this thing, okay. So let's find the total cost under the factoring now. Okay. So this is the cost under the factoring. Should we FATA?
Yes.
Should we do the factoring?
Yes.
Are you sure? If you factor the total cost that you are going to incur is 269 and 250 if you are doing everything on your own.
No, we shouldn't factor.
You shouldn't factor, isn't it?
Yes.
Okay. Another way of doing this is you can do it on a net basis. The net basis is what you are going to do is currently you are paying commission of this one. Even if you factor commission and commission, there won't be any issue with that. I'm coming. Bad debt. Okay. The factoring will help us to do what? If we are factoring, we are not going to pay the 12,500 and 20,000 as those figures. So that will be savings under the factoring. That will be savings under the factoring. That savings is supposed to come. Because if you are not factoring, if you are factoring, this cost you are not going to pay again. So if you are factoring, it means that this cost will be net against the factoring cost. Okay, sorry. Let's bring the savings. Cost savings under the factoring. Cost savings under the factoring. What will be the total cost savings? It will be 14,500, which is a 12,500 plus 12,500 plus 2,000, which is 14,500 if you are factoring. Okay. Still, we cannot factor. You can see still that is 254, 625, and this one. There is be an increased cost of this one. Let's look at this. We can also do this one on net basis. We ask ourselves, if we are factoring, what are the benefits that we are going to get? If we are factoring, what are the benefits that we are going to get? You see that there will be a reduction in our bad debt, isn't it? If you are factoring, there will be a reduction in our bad debt. What is the bad debt figure under the current policy? It is 67,500. If we are factoring right now, we are going to have 9,000. There will be a reduction in the bad debt of the difference. So we look at the cost savings, the net cost. Let's look at the net effect. I normally recommend that if you want to do it on a total basis. So bad debt, there will be a savings in bad debt. There will be a reduction in bad debt. That is a savings for us, and that will give us 67,500 minus the 9,000. That will give us a difference of what? That will give us a difference of 67,500 minus 9,000. That will give us 58,500. Even if we are factoring, the salary and those things, we are not going to pay it. That will also be savings for us, 12,500, and also the credit control cost. We are not going to incur that one too. That will also be 2,000. These are savings. Okay, let's look at the finance cost. If we are using the factoring now, our finance cost will now be, we have 4,500 minus the initial finance cost, which is 56250. We are going to have a savings of, we are also going to have a savings in finance cost of the difference, which is 51,750. Okay, then you now take the cost that you are going to incur from this. The first one will be the finance charge, the one-off payment. So we come to the finance charge costs. These are all costs. So we come to the finance charge costs, which will be the 15% that they are going to charge us. So 15%. The 15% that are going to charge us will be 28,125. The one-off payment that we made to the FATA will also be additional cost to us, which is 25,000. And the FATA will also charge us 4% for finance service. For finance service, which is 90,000. These are all costs. So you put them in brackets. These are all costs. You put them in brackets. These are all costs. You put them in brackets. So this will also be in brackets. This will also be in brackets. Then we come to a finance charge, which will also be 90,000 that they are charging us. Okay. Let's see whether we are going to incur any cost on the factoring again. One-off payment, this, bad debt, we have done that, and finance charge. The commission, whether we factor or not, we still pay the commission. So the commission cost is irrelevant. The commission cost is irrelevant. So let's total this and see. So let's do this and see. You can see that we are having a negative. We are going to spend more than we will earn. So we will not factor. Let's come to what we did first. Let's find a difference between these two. Let's find a difference between these two. The difference will be this minus this. Okay. It means that the cost 7 should not come. 0. So, okay, this will be the same thing like this. These are the costs that we are going to incur. So, if we factor, this is the figure that we are going to get. This is the net expenditure that we are going to get, and this is 1.2 you will get. So, you can do it on a net basis, you can do it on total basis. The cost savings over here should not have been come because it's not a cost that is relating to the policy, so it will not come. So if you are doing it on net basis, you get this figure and you also get this figure. But if you want to do it one by one. Find the current cost under the policy and you also find the cost under the factory. Compare the two costs. If the factoring is giving you a lower cost and the current policy is giving you a higher cost, then you factor. But if the factor is giving you more cost than the current policy, then don't factor. This is all about the receivables. You compare the cost under the current policy to that of the old policy. Let's look at cash management. So that we finish. Let's look at cash management in the next 30 minutes. Then we call it a day. The first thing, if you are looking at cash management, the first thing is you have to look at the motive for holding cash, the objective for holding cash. The first one is for transaction purposes. You can hold cash for the day-to-day activities to purchase goods and services. That is for transaction motive. You are holding cash to buy goods. So if you are a business person, if you are trading in buying cars and those things, if you are holding cash for transaction motive, it is mean that you are holding the cash to buy your stock. So every business needs cash to meet its regular commitment of paying its account payable like employees, wages, and salary. So keeping cash to take care of your day-to-day activities is the holding cash for transaction motives. Precautionary motive is holding the cash for unforeseen events. Some things you might not plan for it and they might happen. So what you do is that you will keep additional cash for those events. This thing normally happens when you go to the market. You have written everything that you are going to buy on your sheet, but you go there, you see something that will be nice to you, and that is not part of your plan, and you spend on it. Assuming you don't have cash, will you be able to spend on that? So you holding the cash to take care of these situations where you go to the market, you buy what you didn't plan for, is holding the cash for precautionary motive. Another way is also holding the cash for speculative motive. The issue is you are holding the cash that whenever there is an investment, you buy it and sell it at a profit. That is speculative motive. So you are just holding the cash, putting the cash there that whenever there is an opportunity that will give you an increase in the value of the cash, you take advantage of that opportunity and take the increase. So you are holding the cash that whenever there is an investment, you have the cash. Whenever they say the treasury bill value is high, you go and buy and you make the gain. That is for the speculative motive, holding the cash to add a surplus to it. So for potential investment, when there is a chance, when there's an opportunity, then you use the cash to take advantage of it. That is for speculative what? Motive. That is for speculative motive. How do we manage cash? We use BAMO model and we also use the Miller-Orr model. The Miller-Orr model is the one that will normally come in the exam. The BAMO model is just saying that if we should know how we should manage our cash, we should know our minimal cash usage. We should know at what level are we going to demand for cash. At what level our cash will reach before we request for additional cash. It's just like the economic order quantity. So he's saying that if we should know how we manage our cash, then let's establish a minimal cash reorder level. So at what level, if our cash, at what balance should we request for additional cash? So if our cash is 12,500, it means that if we have this level, then we should request for additional cash. So that is why they are saying that his own is just like the economic order quantity. So he's saying that we should use the economic order quantity formula to determine our optimal cash to be raised. So that is, if the cash is at this level, we should raise the cash. That's what they are saying. So we use the same formula, which is Q is equal to 2 times CS all over I, where the Q is the optimal amount of cash to be raised. X is the amount of cash to be used in each time period. So amount of cash to be used in each time period. The C is the cost per sale of securities. I is the interest of holding cash or near cash equivalent. Let's look at one question under this. Then we look at the Miller-Orr. Then we know that we are done with working capital management. I'm already exhausted, but how we go on? Let's move on. Let me see whether we can have a question on this one. Then we take it and review. Okay, let's load this. Question 14A. Question 14A. Auntie Lizzie, read for us. Question 14A. Question 14A. Auntie Lizzie. Auntie Lizzie, are you there?
Hello?
Yes.
Hello? Okay. Still on mute. Entity X uses bank account for its daily expenditure. There are no payments into the account. Instead, whenever the account needs more cash, Entity X sells a quantity of marketable securities. These currently provide an interest yield of 5% per year. The cost of selling security is 60 cedis per transaction, regardless of the size of the transaction. Annual payments from the account are 3 million Ghana cedis. Require using the Miller-Orr cash management model to decide the optimum size of transaction for selling marketable securities and the frequency with which securities will be sold. Assume a 365 days. Yeah.
Okay. So the formula, what is the formula saying? Let's write that formula and then we come back to the question. How are they saying that we should calculate the optimal this one? What are they saying? They say that the Q is equal to what?
Optimum amount of cash to be raised.
Optimal amount of cash to be raised. That is a Q. The S is what? Amount of cash needed to be used in each time period. Cost per what?
Cost per sale of security.
Let me use Q is equal to square root. I don't have square root on my calculator, so I have the 2 multiplied by C multiplied by X divided by I, isn't it? Okay.
Yes.
So the I is the interest cost of holding cash of near cash equivalents, cost per sale of securities, amount of cash to be raised in each time period, and optimal cash to be raised. So cost per selling securities, amount to be raised, amount to be used, and interest cost of holding cash equivalents. Let's look at the question 14 again. Okay. So let's come now. What are they asking us to? They say we should use this one to determine the optimal size of transaction. That is a Q. That is a Q. But let's come here. There are no payments into this account whenever the cash, whenever the account needs more cash. Entities sell a security of a market, sells a quantity of marketable securities. This currently provides an interest of what?
5%.
5% per year. Okay.
Yes.
The cost of selling security per transaction, regardless of the size, is what?
50.
60. Annual payment from the amount, annual payment from the account are what?
It's 3 million.
Is 3 million.
Million.
Okay. So let's compute the Q. Let's compute the Q. Let's compute the Q. What are we getting? Q is equal to 2 multiplied by
60.
By 60 times the 300,000.
3 million.
3 million, all divided by 0.05, isn't it?
0.05. Yes.
Okay. How much are we getting?
Add 84853.
Okay. 2 times 60 times 300,000. 3 million, all divided by 0.05. Okay. It will be, quantity will be what? Will be K divided by, this will be in cedis. So don't worry, it will be 84853. Am I correct?
Yes, 53. Yes.
Okay. So the question now is, they say marketable securities and the frequency with which securities will be sold, assuming 365 days in a year. So the frequency.
The frequency with which securities will be sold.
Yes. How do we calculate the frequency? How do we calculate the frequency now? How much do we need?
So we don't know.
How much do we need? How much do we need in a year?
We need 3 million.
We need 3 million, isn't it?
Yes.
We need 3 million, isn't it?
Yes.
Okay. And each time, how much do we have to raise?
84853.
Okay, so how many times do we have to sell our securities before we get, that is the amount needed a year is 3 million.
Yes.
It's 3 million. But each time we need to
Yes.
raise what? 84, 84,
85.
853, isn't it?
Yes.
So how many times do we have to sell our securities so that we raise this amount regularly? It's the same as the how we find the other size, which is this amount divided by this. So 3 million, how many times are we going to sell this one to have this?
36 times.
Okay, so that is what they are saying. The frequency is also calculated as the other size, which is this divided by this. All right.
So 35 rather.
Okay.
Because I had 35.75.
Okay. But if they ask you to find your daily the daily cash demand, they can ask you to find the daily cash demand. Then you divide by the number of days that we have, which is 365 days, isn't it?
Yes.
All right. They can also do this. They can also ask you this. There can be a question that they will ask you. There can be a question that they will give you this. Where is that question? There can also be a question that they will ask you this. The cash demand. The cash demand over here, they will not give you annual. They will give you daily. Are you okay?
Yes.
If they are giving you daily, then if you want to use this, what you do is that you also have to change the interest rate to daily. So you have to come and divide this one by 365. Or you will now multiply by the daily requirement by the 365 days to get the annual. So they can give you any of them. You have to find it before you do the calculation. Are you okay? Let's look at Miller-Orr. What is Miller-Orr saying? Let's solve two examples under Miller-Orr. Then we call it a day for working capital management. So the working capital, the BAMO model follows the same thing. It's just saying that we should know the amount that we should be raising, the ultimate amount that we should raise from everything that we have to do. How much should we raise? How much should we raise? Okay, let's look at the Miller-Orr. Miller-Orr model consider a level of cash that should be held by a company in an environment of uncertainty. So they're saying that, okay, we operate in an environment that we don't know what will happen. But what is the minimum cash that we should have at hand? What is the minimum cash that we should have at hand? The minimum cash that we are having at hand means that we are not going to allow our cash to fall below that particular amount. So he's saying that if we have idea about the minimum cash that we should raise, then we will not allow our cash to fall within that particular level. So that is the idea that he's saying, that if the company knows the amount of cash that is requested of them to hold, then they can forecast their cash level. The decision rules are simplified to two control levels in order that management are of the cash balance of management, that the management of the cash balance can be delegated to a joint manager. So we establish, if we know the minimum cash level, then you also establish your maximum level. At what level you should not expend your cash over. And we also look at what we call the return points. The return points. The return points will also be seen as the reorder level. The reorder level. At what level should they request for additional cash? That is the return point. That is the return point. These are all formula work. The minimum level will be given to you in the question, but you have to calculate the maximum level. The maximum level is the minimum level plus the spread. The spread is calculated as this. The return point is the minimum level plus 1/3 of the spread. How do we calculate the spread? The spread is calculated as 3 multiplied by 3 times the transaction cost times the variance of cash flows, all divided by 4 times the interest rates, then all the answer exponents 1/3. So what you can do is that you can have 3 times the cubic root of all of this. quick root of all of this. Or you can have the 3/4 multiplied by the transaction cost times the variance cash flows divided by interest rate or exponent 1/3. So this formula will be given to you in the exam. This formula will be given to you in the exam, and they'll ask you to calculate the other things. Let's pick a question, then we look at how we calculate. Let's pick 2 questions, then we look at how we calculate that, then we move on. Let's look at this question. Question 12. Question 12. Let's look at question 12. Auntie Joyce, Auntie Lee, help us with the question 12.
And 12.
Yeah.
Required using the Miller-Orr model, determine the following: the cash spread between the lower and upper cash limits, the cash returning point, the cash level at which the company should invest excess cash.
Okay.
You are the assistant to the finance manager of
You
Command
okay?
Holding Limited.
Okay.
Directors of the company.
Okay. Continue.
The directors of the company are reviewing the cash management practice of the company. The main concern is that excess cash balance are held in a non-interest-bearing demand deposit account for relatively long period. Your boss has been asked to advise the directors on the appropriate cash balance level of the company should keep and matters relating to the investment of excess cash. To assist your boss, you analyze the company's demand for cash over the 3 years and look for some financial market figure. On the usage of cash, you found out that the company's daily cash needs vary with standard deviation of 25,000 Ghana cedi. However, the annual demand for cash average around 65 million Ghana cedi. Considering the result of your examination, your boss proposed that the minimum cash balance is set at 100,000 Ghana cedi going forward. From your search on the financial market, you found that the company can earn interest from investment in money market security at annual rate of 21.6% on an actual 365 days count conversion. Also, we found out that the average transaction cost for trading investment in such money market securities is 3,500. Your boss recommend using the Miller-Orr model for determining the criteria cash control level and investment of temporal asset cash in money market security. Required using the Miller-Orr model, determine the following: the cash spread between the upper and the lower limit, cash limits, the cash return point, the cash level at which the company should invest excess cash.
Okay. So the cash spread between the lower and the upper limits, that is the spread. They're asking you to find the spread. They're asking you to find the cash return point, the cash level at which the company should invest excess cash. That is the maximum level. That is the maximum level. But how do we calculate the spread? The spread is calculated as 3 into brackets, 3 into brackets, 3 into brackets, 3 times what? Okay, let me show you the formula again so that you write it somewhere. Okay, spread is calculated as 3 into brackets, 3 times transaction cost times 3 times transaction cost. I will make it 3C. I'll make it TC multiplied by variance of cash flows. Variance of cash flows. Okay. All divided by 4 times the interest rate. The interest rate, all of this answer exponent 1/3. All right. Can we move on now? Have you written it down?
Is the 3 multiplying the variable cost too?
The 3, is it multiplying what? Which one? The 3
Is
times
it
the transaction
multiplying both
cost.
the transaction and the variance, the
Yes,
variance?
is the multiplication of all. So 3 multiply all the top.
Okay.
They are all multiplication. Are you okay? But you have to do this one first before. You see what you have over here? The first bracket. You have to do the first bracket before you multiply the answer by 3. Are you okay? Let's go and pick what we have.
Okay.
It's very simple. Cash management is always simple. They have examined it twice already, and nobody knows. Let's look at this question. So they say calculate the cash spread between the lower and the upper limit. That is the spread. That is the spread that they are saying. So let's count to the spread. What is our transaction cost from this question? What is our transaction cost from this question? Also, you find out that the average transaction cost for trading investment in such money market is what?
2,500.
Okay. What is our variance? Are we giving a variance? No, but we are giving standard deviation. The square root of standard deviation is the variance. So always the question will give you standard deviation. Find square root of the answer. Find the square root of the answer. So square root of that one is what?
25.
Find square of, not root, square of standard deviation is the variance. So the square of 25,000 is the variance demand. So what will be the answer? 25,000 times 25,000. How much am I getting?
Six, 625.
8 what?
625. 625 million.
625 million, isn't it? Okay.
Yes.
So I'll just put 625 million here. So the question will always give you standard deviation. Square of a standard deviation is the variance. So just find the square of the standard deviation question, that standard deviation figure that they are giving to you. But what is the figure given to you over here? This is a daily cash needs with a standard deviation of what? 25,000. So the variance given to you is a daily needs. It's a daily variance needs. But what is the interest rate? What is the interest given to us in the question?
21.6%.
But this figure is on what? It's annual, isn't it?
Yes.
But the cash that we are using, the variance that we are using is daily. So we
Daily.
also find a daily rate. So you can see that they are giving you a 360 day. So you divide this by 360 to find the actual interest rate. Are you okay? So let's now find the spread.
Okay.
Let's now find the spread. The spread will give us 3 multiplied by 3 times the transaction cost. What is the transaction cost? 2,500.
2,500.
Okay, times your variance. Your variance is 625 million.
625 million.
Okay. Then all of this divided by 4 times your what?
Interest.
4 times your interest. So find the interest. Find the daily interest, which is 21.6 divided by 360. How much are you getting?
360.
So you get 0.6.
0.06.
0.06. Then you multiply that particular answer
0.06.
by 4. Then all of
4.
this will be exponents 1/3. Let's do it and see what we are getting.
1/3.
Okay. So the spread will give us, the spread is equal to 3 into brackets. So do all that. Let me see. 3 times 2,500 times 625 million, all divided by
Yes.
all divided by 0.06 times what? 4. What are you getting?
Oh,
So 3 times 2,500 times 25,000 exponent 2. All divided by 0.24. And come, let me check the formula again. Let me check the formula again. Maybe what I'm using is not the right one. Okay. So 3 outside. Three. Is 3 times 3,100. That's 2,100. Okay. 8 times. Auntie Joyce, what are you getting? Is it my calculator or?
same. I was also getting same. I was getting some figures raised to the power 14.
Auntie Joyce, the interest rate. Auntie Joycelyn. Joycelyn, are you there? Joycelyn, are you there? Auntie Joycelyn, are you there? Auntie Joycelyn, are you there?
You try.
Auntie Elizabeth, are you there?
Yes, I'm here.
Okay, in less than 15 minutes, people will be taking over the accounts. So this one, the interest rate, we are doing a mistake. The interest rate was 21%, so we have to change it to percentages, which will be 0.216. So let's find this. Let's find out what our calculator. 0.216 divided by 360. That will give us 0.0006. So the interest rate was given in percentages, so we need to do it in percentages. So we change this one to 0.216, not 21.6. If you are saying 21.6, it means that you are using a whole number. So what we are going to do over here is this will be 0.006. Let's see how much we are getting. 0.006. Okay. So let's do everything on our calculator and see what we are getting before these people will take over this. So our spread will be exponent 3 into bracket 3 times 2,500 times 25,000 exponent 2 divided by 0.0006.
The same thing. I'm getting 3.125. Which is like 15.
No. How did you do it? Let me show you how you do it. You see what I taught you the last time, shift and the exponent, the x with the bar.
Yes,
So do the shift x bar. So you see a box at the top and a box in the square root, isn't it? Have you seen something like that?
yes.
So you put 3 at the top there.
Yes.
Then you come to the bracket, you put the fraction in the bracket. But what we did first was, you see the percentage was 21%. We're supposed to be 0.216 divided by 360. It should not be 26. It should have been, we should have changed it to decimal because it's a percentage. So we should have changed it to decimal. We should have been 0.216 divided by 360, which will give us 0.006. So you will now have 3 times 2,500. Have you done that? Times.
If when I press the shift and then when I
6.
press the shift and then the
So you have.
is it where the 3 square root is?
You said?
I'm asking whether it's where the 3 square root is.
Where
The shift and the 3, where the 3 and then the square root is.
This no,
it
it's
that
shift and the s power. You see x power on the calculator. After the s square, you see x and the box at the top before the log.
Yes, yes.
Then you
yes.
press the shift and that. You see that you have a power and then the square root.
Yes.
So the box at the top of the
I
square
put 3
root,
there.
you put 3 there. Then you come into the square root itself. Then you press the fraction sign. There's a fraction sign there.
Yes, I've done it.
So then you put the 3. Then you put 3 at the top. 3 times 2,500 times the 625 million. Have you done that?
Yes.
Then you now have division. You now come to the down. Then you put your answer there, which is a 0.006.
0.0006. Okay. Times 4.
Times 4. No, yeah, times 4. Yeah, times 4. What are you getting?
I'm getting 125,000.
So 125 is all of that. Then you use 3 to multiply the 1. Because all that we have done is the 3 multiplied by this one. That is what we got the 125. So you now use the 3 to multiply that particular 125 to get your total spread. So the 3
the 3 is already there. Oh.
No, the 3 is the first one that we did.
You made me put the 3 there.
Yes, the 3 is the 3 times the transaction cost. But the 3 that we did at the
No,
top
no,
is the
no,
1
no,
over
no.
3. The 1 over 3 is the one that we changed.
Okay.
Is the 1 over 3.
Oh,
So the
okay,
3 will
okay.
now multiply the 125.
The 125.
And that will give us how much?
4166.
Now, if you use 3 to multiply that, I'm having 375.
Every time 120. Yes, 375,000.
So the spread is 375,000 Ghana cedis. That is the spread. So after getting the
This
spread,
long process.
you can now find your maximum level. The maximum level is the minimum level plus the spread. So the maximum level is equal to the minimum level. The question will always give you the minimum level. Let's look at the minimum level from that place. What is the minimum level from the question? In the question, what is our minimum level? So the boss proposes that the minimum cash balance is set at what? 100,000. So this one will be 100,000 plus the spread. The spread is 375. So 375,000. So our maximum level will now be 475,000 Ghana cedis. 475,000 Ghana cedis. Let's come to the return points. The return point is the minimum plus 1/3 of the spread. So we have the 100,000 plus 1 over 3 times the spread. The spread is 375,000. So 1 over 3 times that one will give us 125. So the return point is equal to 225,000 Ghana cedis. Okay, so the only thing that is the problem is how to find the spread. After getting the spread, you are good to go. Let's pick another question. Then we know that we have solved 2 questions on this one. Then we close because people will come and take the Zoom app now. They will come and take the Zoom app. Okay, let's look at another question. Then we stop there. Then we know that we have solved 2 questions on this one. Then the understanding will also come. Okay, let's look at this question. Okay, let's look at question 5B. Let's look at question 5B. They say,
Rempec.
Okay, Renpeco, a subsidiary of Unico, has set a minimal cash account balance of 7,500. The average cost to the company of making deposits or selling investment is 18 per annum, 18 per transaction, and the standard deviation of this cash flow was 1,000 per day during the last year. The average interest rate on investment is this. Determine the spread, the upper limit, and the return point for the cash account of this using the Miller-Orr model. So what you do is that you can see that they have given you, they say we should calculate the spread. So let's do the spread first. So the first thing is spread. What we have to know is that we need to know the transaction cost. What is the transaction cost in the question? The average cost to the company of making deposit or selling investment is 18. So the transaction cost is 18. What is our variance? The variance will be the squared of
Variance of the deviation.
Okay, so what will be the total answer down? That will be 1 million. Am I correct?
Yes.
Our interest now is what? And if you are not giving the interest, every interest given to you, assume that the interest is what? Is per annum. So this one is per annum. But you can see that the deviation given to you was per day. So you have to use the interest that is also per day. So for you to get the interest over here, it will be 0.0511 divided by 365 days. If you are not giving anyone, you use 365 days. You use 365 days. So what would be our interest now? What would be our interest per day?
I said, so if I'm getting you, because they said it has a cash why are we
Yes.
dividing it by the
Yes, we use the interest
or the cash
based on the
minimum?
cash flow. We use the interest based on the cash flow. So if they give you standard deviation per annum, then you use the interest per annum. But if it's given per week, then you use the
Okay.
interest per week. If it is given per month, then you also change the interest to per month. If it's given per day, you also change the interest to per day. Are you okay? All right.
Okay.
So what would be our interest rate per day? 365. I'm getting 0.00014. Am I correct? You can see that you are having 1.4 times 10 exponent negative 4, isn't it?
Yes.
10 exponent negative 4 means that whenever you have 0 point additional 3 zeros to count. So you should have zeros, you should have 4 zeros, including the decimal point. You should have 4 zeros. So 0.0014. That is our
Okay,
interest
okay.
rate. So let's now calculate the spread. The spread, the same thing. Shift the x power, you put 3 over there, then you put fraction sign in the box, then it will be 3 times your transaction cost now 18 times your 1 million. Are you with the same path? Are you on the same path with me? All divided by 4 times 0.00014. What are you getting?
Yeah, 3 times.
You have the shift, the one that we did first, then 3 at the
I've
top.
done it. I've done it.
Then it will be 3
Yes,
times
I've done
the
it.
transaction
Then the
cost.
interest,
The transaction cost is how
yes,
much? 18.
118, yes.
Okay, it's 18. Then times the 1000 exponent 2, all divided by 4 times
1 million,
4 times the 0.00014.
0.04586,
Are we there?
yes.
So you have
4586,
4586. That is the spread, isn't it?
86,
Okay.
yes.
So for you to know the return points, the return, that is the spread. The return point is the minimum cash balance. What is the minimum cash balance? 7,500 plus 1/3 of the
Yes.
spread. So you find 1/3 of this. Okay. The answer that you are getting, you multiply it by 3. That will give you the spread. So 4586 times 3. That will give you the spread. So the spread is 13758. So your return points will give you the minimum, which is 7,500 plus 1/3 of the spread. 1/3 of the spread. So 1/3 times the spread, which is 13758. That will give us how much? The maximum is the minimum plus
The spread, did you get 130?
the spread.
I thought we had 4, 5, 8.
Then you use 3 to multiply the answer because 3 is at
Okay,
the,
times 3.
yes.
True.
All that we done
It's
is
true,
the
true.
first bracket, is the one in the bracket. There, the answer that you get, you use to multiply it. So the maximum is the spread. The maximum is the minimum plus the spread, which is 13758. 13758. So you get the answers, then you put them there. I'm even tired. All right. So we have done 2. There are a lot of questions with the spread. You can try them. You can try the spread today. The one with the spread. Spread might be likely to come. Spread and inventory. Receivables came last sitting, so it will not come again. The spread. But you can still try the receivables. You can still revise it. But the spread is likely. The inventory is also likely. So solve some questions. Justin, I can hear you. Auntie Jocelyn, I can't hear you.